This is Al Brooks. Thank you for watching the Brooks Trading course. In this video, I'm going to be giving some examples of swing trading. I will specifically give day trading examples for swing traders. An important observation is that on the open, 50% of the opens have a breakout that fails and reverses. For example, in this particular slide, you can see that the market sold off strongly on the open and then reversed up, trapping the bears. That's an opening reversal. And that sell-off reverses up, usually at some kind of support, although you cannot see the bars to the left to see the support. When you get the reversal up, here we have an outside up bar, a good sized bar, and then we have a second good sized bar, very little overlap, closing on the high. This close is far above the high of that bar. This close not only is above the high of this bar and above the moving average, it's also above the high of this final bear leg. So at that point, there is probably a 70% chance of at least some kind of a measured move up. The first thing I always look at when you got an initial breakout like this with big bullish trend bars is I look for a measured move based upon the open of the first bar to the close of the final bar. So at this point, here's the final bar. At this point, the final bar is here. At this point, the final bar is here, and then here. All the way up, I keep increasing my measured move. The chart is at this point, and I don't see all of those other bars. I'm looking for a measured move projection based upon this open to that close, which projects up here. By the time this bar appears and closes, I would move this line to here, and this line would then get moved further up. But in any case, I think the market clearly became always in long at this point, and at that moment, there was a 70% chance that we would get at least a measured move up based upon the size of the breakout, either the low of the bar to the high of this bar, the open of this bar to the close of that bar. A lot of bulls will therefore buy the close of this bar. And so as soon as that bar closes, they either place a limit order to buy at the price that the bar closed. Sometimes you do not get filled. And the other alternative is to simply hit buy the market. So as soon as this bar closes, you click buy the market and you get filled pretty close to the open. Also, as the market's going up, if you did not buy the close here, you simply can buy at the market at any point because you know there's a 70% chance of the market going at least to this point. And as the breakout increases in size, the size of the target gets further up. Let's say you did not buy this close, and then the market goes up to this bar. You know this is a logical entry price, so some traders are looking for reasons to buy. They could buy the market, this blue rectangle, or they can simply place a limit order to buy a 50% pullback. So at the close of this bar, they can place a limit order to buy a 50% pullback from the original entry price to that close. And if they were lucky, they'd get filled with that pink box right there. So now we have, at this point, 3 strong bars. We ended up with 4, 5 strong bars. And at some point, this breakout phase of the trend is followed by a pullback, a little pullback here, a bigger pullback here. And typically what happens after the pullback is either the market enters a trading range and then decides between trend reversal down and trend resumption up, or the pullback leads to a channel, as was the case here. Here's the pullback. You can argue that there was a trading range as well to this point, and then we got a good buy signal bar and trend resumption up. But to me, this is a bear channel, a bull flag, 3 pushes down, 1, 2, 3. Does not matter that the trend continued higher after the first pullback. These 2 bars are part of the pullback that began with this reversal down. So to me, this is a wedge bull flag, and this was the end of the pullback, and this was the start of the channel. Eventually, when you have a bull channel, you think of it as a bear flag, 75% chance you're going to get a bear breakout, and usually an evolution into a trading range. Did the trading range begin here? You certainly have trading range bars starting right there. So 3 dojis, 4 dojis, 5 dojis. Out of the 10 bars here, they're almost all dojis. we continued higher, but the trading range might in fact have begun here. And you can see we reversed down strongly and tested the bottom of that developing trading range. When I start to see a series of dojis like this, I wonder if the channel is beginning to evolve into a trading range. Again, a very strong bull breakout like this, probably 90% chance you're going at least a little bit higher, 70% chance you'll probably go high enough up for a measured move based upon the open or low to the close of the final bar of the breakout phase. The 10% of the time when this breakout leads to the high of the day and a reversal down, it's usually a fairly clear parabolic wedge top, and this is not. You could argue first push up and then pull back, and then second push up and pull back, third push up. This is not how parabolic wedges typically look. Normally the first push begins after the low, and usually you have at least one or two bear bars along the way. Although this could be a parabolic wedge top in the high of the day, maybe only a 10% chance it's going to lead to a major reversal, 90% chance it leads to a pullback, and then at least either trading range or continued trend. The first push began during the bear leg, not typical for parabolic wedge tops. You can call this the first push, and then pullback, and then second push, pullback, and third push. But again, no bear bars along the way, and if there's no clear argument for a wedge here, it's probably not a parabolic wedge top, and therefore the probability that this is a major reversal in the high of the day is only about 10%. When you do get a swing trade on the open or the first hour or so, it typically lasts for 2 to 3 hours, but it can be as short as 30 minutes. We could just go up for 5 or 6 bars and then reverse down. Or it can be as long as 4 hours or even last all day. Once you start to evolve into a trading range, you can get a late reversal down instead of trend resumption up. I talked about that earlier. Bull breakout, and then a channel, and then it evolves into a trading range. And the trading range has about a 50% chance of trend resumption up versus trend reversal down. I talk about this more in the videos on trading ranges. Here's another chart with a very strong reversal up, and we have a micro double top and a pullback, a wedge pullback, 1 or 1, and then 2, and then 3. This is a buy the close finish from yesterday, and we tried to get follow through buying here. We tried here and it sold off. Then we tried again a second time from a micro double bottom and sold off again. And then we ended up with a pretty strong reversal down. So a micro double top, reversal down. But when it follows a very tight bull channel like this with no bear bars on the way up, it's probably only going to be a minor reversal, which means a bear leg in what will become a trading range. Take a look at how strongly down this is reversing, closing on the low. A second big bear bar closing on its low. During the open of the day like this, if I see 2 big bear bars closing on their lows, not much overlap, I conclude the market is always in short and that we'll go down for some kind of measured move. Even though I think there'll be buyers around a 50% pullback from this strong bull trend, and I think this is going to end up as a bear leg in what will become a trading range, at this point, 2 consecutive strong bear bars, I think we're going down further. And then here we have 5 consecutive bear bars, all closing below their midpoints. That means a high probability that after the first pullback, we'll get at least a little bit more down. High probability there are sellers above the high of the prior bar. Bears will sell with a limit order at the high of that bar, and they get filled here. Even though it's a strong bull trend bar, chances are after 5 strong bear bars on the open, we're going down at least a little bit further. So we have a micro double top, up and down, tried to go up again and turn down, and then a pair of big bear bars. You could sell the reversal down, or you could sell any of these closes, or you could sell above that bear bar, arguing 5 consecutive bear bars, closing below their midpoints on the open, probably at least a little bit more down. I describe this as a wedge. First push down, either that low or this bear bar or that low, doesn't matter. We went up and down here, and then a second push, and then pull back, and then a third push. So to me, this is a wedge bull flag and a 50% pullback from yesterday's close. Also, take a look at here. You see the high of this bar and then the moving average. See right in there? There's a gap. There's space between the high of this bar and the moving average. So that's a moving average gap bar. And that often leads to the final leg of a bull trend before the market attempts a major trend reversal. Here, a lower high major trend reversal. As strong as this is, it's still the first reversal down, so probably a minor reversal. At this point, you have a lower high major trend reversal. Bull trend, pretty good breakout, a lot of bear bars, and then a lower high. However, after 5 consecutive bull bars, usually that is not going to lead to a successful reversal, even though it is a major trend reversal. We got a sell-off, 5 bars down, and then we got another rally. So it looks like a triangle. 3 pushes up, 1, 2, 3, and then we're in breakout mode. We have a smaller triangle at the apex of a bigger triangle. So we have a big move up, a big move down, another big move up, another big move down, big up, big down, big confusion. Big confusion means traders do not believe the market's going to go down very far. They also do not believe it's going to go up very far. So they're going to exit quickly, and that results in the formation of a trading range. And a triangle is a type of a trading range. You might sell the lower high major trend reversal, but after 5 consecutive bull bars like this, chances are, again, it's a minor reversal just like that. And chances are this is going to be a minor reversal up because the bear channel is so tight. Usually you do not get a protracted bull trend after a very tight channel like that. In a triangle, breakout mode, 50% chance bear breakout, 50% chance bull breakout, 50% chance the first breakout up or down fails and reverses. We have the bear breakout, and it's a 2-legged pullback from the high. So 1, and then triangle, and then 2. Leg 1, and then a pullback, and then 2. So this is a large high 2 buy setup, and it's possibly a failed breakout below the triangle. This is not a good-looking buy signal after 4 consecutive bear bars. Traders would rather buy above a bull bar, like above this bar, or above that bar, or above that bar. Or if they want higher probability, they wait for the breakout, a very big bull breakout bar. The bears tried to get a low 2 short, first leg up, pull back, second leg up, tried to reverse down. Instead, we got a strong bull breakout above this low 2 bear flag. At this point, the bears are getting lower highs and lower lows, a bear channel. And here we got a strong bull breakout, a big bull bar closing far above the highs of the past 10 or 15 bars. And then the following bar has a bull body as well, and that increases the probability of at least a second leg up. Leg 1, and then pull back into a triangle, and then leg 2. And traders will start buying above bull bars, buying close, buying above this bull bar, and then buying closes, and then a high 1 bull flag after a strong breakout, probably at least a little bit more up. Now, what about this low 2 short? We're in a bear channel, lower highs, lower low, a 2-legged pullback, and technically it's a short, but we have 4 consecutive bull bars here, 3 of them pretty good sized bull bodies closing near their highs. Probably this is a minor reversal, and the best the bears will get is sideways, and they might get a total failure and a bull breakout. We have the legitimate bear flag, and we got a bull breakout. Big bar like this, you got to be thinking about a possible measured move up, maybe from this low to that high. You can call this another wedge here, 1, 2, 3. But whenever you have a strong breakout bar like this, we're probably going to get a second leg up. And to me, this is an example of consecutive tops. So we tried to top here, 1 pullback, 2, and then we got a strong breakout, probably a second leg up. Low 1, low 2. So it's a low 4 sell setup. Low 1, low 2, strong bull breakout, and then another complex top, 2 attempts. Low 1, low 2. So we're probably going to fall for at least a couple legs. This is a fairly common pattern on the open where you have a parabolic wedge top. Yesterday we had bear channel, bull flag, 3 pushes down, 1 pullback, 2 pullback, and then today bar 3 and a wedge bull flag. And then we get a bull breakout and follow through buying. A big bull bar, probably always in long. We're trying to resume up after the bear channel. So always in long, traders buy that, they buy that. They buy another bull close here. They buy below the bear bar, betting the reversal will fail. They buy the high one buy on the resumption up. They buy the breakout of this pullback. However, whenever you see a strong rally, another buy climax, and a leg 1, leg 2, and a buy setup for leg 3, you have to be thinking about the possibility of a parabolic wedge top and an early high of the day. When you get that third push up and you see a particularly big bull bar closing on its high, you got to be thinking that it might be an exhaustive end of a strong rally, and that rally might be a bull leg in what could become a trading range. It could also be the end of a rally that leads to a bear trend. Yesterday we had a bear channel, and today we tried to break below, and we instead reversed up pretty strongly. You can also call this an expanding triangle. 3 pushes down, 1, 2, 3, and then 3 pushes up, either 1 or 1, and then 2, and then 3. But I think the market just went always in long here. So first reversal down, even though expanding triangle, that first reversal down probably will fail. So we have a failed top and a breakout. So you got to be thinking after the breakout, we might get a second leg up. So we had a top attempt and a bull breakout, and you typically get a second leg up when you have a top that fails. However, that leaves us with 3 consecutive buy climaxes here, or you can say this one has 2 in it, 1 and then 2, and then a smaller one here, and then a bull flag. You got to be concerned that we might get a third one up and then a reversal down and an early high of the day. When I see this, I'm thinking this is more likely a bull leg in what will become a trading range, or a possible high of the day and a reversal down. In any case, you have to be prepared to sell. You can sell below that bear bar. You can even sell above this bull bar, betting that it's a parabolic wedge top, probably not going much higher. Higher probability to wait for a decent reversal down and follow through bar, or a breakout. Here we have an attempt at a bull flag, and we get a breakout and a follow through bar. So this is a sell to close sell off. And then this is really important. A big bear breakout with a decent follow through bar. This might end up being a measuring gap for a second leg down. So you can sell that close, higher probability to sell here, or we got a low 2 bear flag, bull bar, first leg up, and then a bear bar, and then a second leg up. So this is a low 2 sell, and then more sell to close, sell off. Typically in a parabolic wedge opening reversal, when it starts to reverse, it goes down in a fairly tight channel for 5 or 10 bars. If instead it goes 5 or 6 bars and then sideways or bounces a little bit, then it's probably not going to be a parabolic wedge top and a bear trend. But this is typical when you are going to get a bear trend. You get a reversal down in 5, 10 bars or more in a fairly tight channel, and then you start getting bear breakouts. Again, I think it's sell the close in here, sell the close in here, and then clearly sell the close down there. Another example of a parabolic wedge top, a big bull bar and then a bear bar. Big bull bar and a doji, and then another 2-bar breakout. So it's basically a spike for the first push up, and then second push and third push. So you got to be thinking this could be a parabolic wedge high of the day. Very tight spike and channel bull trend. So spike and channel, and then a decent sell signal bar. Not a particularly high probability sell, more likely will go sideways, but it's a decent sell because the potential reward is much bigger than the risk. So you can sell there, or you can wait for this and that. Waiting for these closes, higher probability of more down. But whenever you wait for higher probability, there's usually less profit remaining, and your stop is further away, so there's greater risk. Either way is okay. Taking the early entry with lower probability and lower risk, in other words, lower probability, better risk reward, or the later entry where you get higher probability, but you pay for it with worse risk reward. Look what happened at the new low of the day. Big reversal up. A lot of times when you have these parabolic wedge sell-offs and you get to the low of the day, you do get a big reversal up. The market's deciding whether it's going to fall for a measured move based upon the height of the buy climax, or instead either go sideways or bounce in a bull channel, which it did here. For the bulls, it's a double bottom and a buy. Very tight bear channel, most likely minor reversal and sideways for 5 or 10 bars, but it is an okay buy. Here, we have a bear breakout and a pullback, but we have a doji here, basically dojis here, and we know traders bought here, and they bought here at the open. When the market opened, they bought and the market went up. So they're probably going to buy again here. This bull bar is a pullback from this bear breakout, but we're in a buy zone, and it's a bad-looking sell signal bar, so probably bulls will place limit orders to buy the low of that bar, so that's another chance to buy. Or you could buy with a stop above the high of the bar. Double bottom pullback, so 3 pushes down. This little tail is 1, 2, 3. This is really not a push down, but it's still 3 lows. A low here, low there, low there. And to me, that is a type of a triangle breakout mode situation. So we have a double bottom, a reversal up, and a pullback from the double bottom. Reasonable candidate for the low of the day. On the way up, we got a low 1. And look at this rally. Where are the consecutive big bull trend bars? Consecutive bull bars, but no consecutive big bull trend bars. We got a bull bar doji, bull bar tail, and then doji, and 3 bull bars shrinking bodies. So this looks like a bull leg in a trading range. So low 1, possible low 2, 50% pullback of the bear leg. You can also call it a double top bear flag, a wedge bear flag, wedge 1, 2, 3, or 1, 2, 3. However, in any case, this looks like we're going sideways to down, so that would be another sell. Starting to resume up. Where are the consecutive big bear bars? Right, bear bar, bull bar, bear bar, bull bar, bear bar, dojis. So this looks like a bear leg in a trading range. However, at this point, low, higher low, higher low, we may be in a bull channel, and we may start to get higher high, higher high, higher high, and higher low, higher low, higher low. This is a reasonable buy for a double bottom, even though the bottoms are not at the same price. It's a double bottom, higher low, and a weak sell-off. Bulls will buy above the bull bar for the reversal up. And then up here, first push up or first push up, second push up, third push up, or first push and then bear bar, second push, then bear bar, and third push, slightly higher high. This looks like trading range price action. So just like bears sold above this bar and made money, they'll probably sell above this bar and make money, especially given that there are different ways to draw a wedge bear flag. And then we got a bear bar closing on its low. So traders will sell below that low, hoping for a swing down, knowing that more likely they'll only get a scalp. Reversing up, I would not necessarily buy above the bear bar, but above the bull bar or the second bull bar, that would be a higher probability buy. Higher low, higher low, higher low, higher low, high, higher high, higher high, clearly in a bull channel. And some traders like to buy with limit orders below bars. Other traders buy as the market's reversing up. And then here, first push up, second push up, third push up. We're trying to break above the bull channel. Tried once, tried twice, and then bear bars, and then a second entry short here. That's a good location to exit longs or even to go short for a scalp down at the end of the day. A wedge lower high, 1, 2, 3, so a wedge, lower high, and a second entry sell. First reversal down, second reversal down. Now, parabolic wedges are not only up, they can also be down. And different ways to look at this. First leg down ended with this doji, or that doji, and then a second leg down and a third leg down. 3-bar sell climax, sell climax, sell climax, sell climax. Whenever you get a series of 3 or 4 consecutive sell climaxes on the open, you have to be thinking about an opening reversal, a parabolic wedge sell-off, and then a reversal up. Now think about this. No matter where you sell in here, it's clearly sell to close. If you're selling here, your stop is way up here. And if you're a bear, your stop is far away. You're expecting a little bit more down, not necessarily a lot more down. And With your stop so far away, you have to reduce your risk. And the easiest way to do that is to buy back some of your shorts. And after consecutive sell climaxes, you're not expecting a lot more down. So you start to buy back your shorts, and that can cause a reversal. Because of the potential of this being a parabolic wedge bottom on the open, it could end up being the low of the day. Maybe if you're selling down here, you could use a tighter stop at the top of the big sell climax here. But when you got the biggest looking bear breakout and it's occurring as the third sell climax in a trend, you have to be thinking that, yeah, there might be one more leg down, but probably not 2 or 3 legs down. This is probably the next to the final leg in the bear trend. And then we have an II bear flag here. So you're going to be thinking it's a potential final bear flag. Yes, you can sell, but you have to be ready for a reversal up. And if you're ready for that, and you see a pretty good looking bull reversal bar like this, you can buy. First reversal up in a very tight bear channel, probably minor. So it might go up 5 or 10 bars. Here it might have gone up 15 bars. And then it probably will test back down and then try to form a major trend reversal. Tried to form one here, failed, got a second leg down, tried again here, and it was successful. A pretty decent buy above that bull reversal bar after the parabolic wedge bottom and a fairly tight stop. Another thing about this, the bears who sold anywhere up here or even down here, they were surprised by the size of this, and they're going to be pretty eager to take profits. They see it as an unusual gift, a big gift. The market is suddenly giving it a lot of profit very quickly, so they're going to be looking to take profits. And as I said, after a parabolic sell climax, a parabolic wedge bottom, you have to be thinking that the market will probably go up for at least a couple of legs and at least 10 bars. 1 leg pullback, 2 pullback, 3, so a wedge lower high. Tight bull channel, probably not much down, but probably still a second leg down because it's probably a minor reversal after a tight bear channel. Once the market is clearly in control by the bears are going to bet that the first reversal up will not get too far. And then we got a bull trend here, not especially big bars, okay bars, but then a pretty good bear bar and another bear bar. We got a micro double bottom and a higher low, only 2 or 3 bars down and only 4 or 5 bars up. Not enough bars for a major reversal. So yes, this could be a higher low major trend reversal, but it's probably a higher low minor trend reversal, which means probably a bull leg in a trading range. Traders will be looking for a reversal down. Because it's probably a bull leg in a trading range, traders would sell below a strong bear bar here. 3 or 4 bull bars might get a little bit more up, so maybe they sell here. They'll also start selling with limit orders above bars, betting that if it's a bull leg in a trading range, selling above the prior highs makes sense because we're probably going to go down before too long. The best stop is probably above the top of the bear leg, bear trend. That has the highest probability of being successful. However, it also has the greatest risk. Above this lower high, above the sell climax are also alternative places where you can put a stop. If it's going to be a bear trend, if we're going to get a lower high, new low, lower high, new low, and channel down, it should not go above the high of that sell climax. Any reasonable stop is good. All 3 of these are reasonable stops, and the wider stop loses more when it's hit, but it loses less often. It gets hit less often. And after you take 10 similar trades like this, your results will be the same whether you use the tighter stop, lose a little bit more often, or the wider stop, lose less often. So any reasonable stop is okay. Here, we pulled back in the open. We got a buy climax and a pullback, buy climax and a pullback, buy climax, pullback, buy climax. You can say 4 consecutive buy climaxes, 1, 2, 3, 4, or you can say this is a strong enough breakout, so we start the count right here, 1, 2, 3. So this is a potential parabolic wedge top. However, remember what I said, if it is going to be a parabolic wedge top, you want it to fall in a fairly tight bear channel. Instead, this went sideways in a fairly tight channel. and that reduces the probability that this is going to be a top. It increases the possibility that we're going to go sideways and get trend resumption up. Look at this rally. We're trying to resume up, but small dojis overlap, pull back every few bars. Does this look like the resumption of a bull trend, or does this look like a bull leg and what will end up as a trading range? Just like this does not look like a bear trend, it looks like a bear leg in a trading range. This is probably a bull leg in a trading range. We're getting some gaps. This pullback did not fall below that high, so that's a sign of a strong bull trend. This sell-off went mostly sideways instead of down, good for the bulls. And remember earlier I said if you are getting a tight channel down after a parabolic wedge top and you get a little breakout, it increases the chances that you're going to get trend resumption up. Here we got a gap between this high and that low. Does not matter that we went above here. You can say it's a negative gap with this high and that low. In any case, it's a gap. We might soon get trend resumption up. You can call it negative gaps, slight overlap between this pullback and this breakout point, slight overlap between this pullback and that buy signal bar high. It's still a sign of strength, and it still increases the chances that we're going to go higher. Look at the size of the pullbacks. We have a parabolic wedge top, and you could sell here, sell there. If you're selling with a stop, are you making money here? If you're selling with a stop, are you making money? If you're selling with a stop, are you making money? No. So it's impossible for the bears to make a profit because the pullbacks are so small. You got to be thinking that we got a combination of a weak looking rally, looks like a leg in a trading range, but all the pullbacks are small and we're forming gaps and negative gaps. Those are the ingredients of a small pullback bull trend. I would be looking to buy, betting that we'll get higher prices. And here we got trend resumption up after the trading range. We have a gap up and two bear bars closing on their lows. I think we're always in short, and traders will sell above the high of the prior bar. So even though this is a bull reversal bar, it's only a small doji, and it follows two much bigger bear bars, probably sellers above that high. So we had a strong rally yesterday, and look at the follow through today. It looks like either a bear leg or a tight trading range. Not high probability for the bulls yet. Traders will sell below that bear bar, failed breakout above yesterday's high, or they'll sell closes, betting on at least a little bit more down. Now I said after two big bear bars, probably at least a little bit more down, bears will place a limit order as soon as that bar closes, a limit order to sell its high, and they'd get filled when this bar traded above that bar's high. So that's at least a scalp. For the bulls, we got a leg down, a pullback, a second leg down. We have a small double bottom. It's a high 2 bull flag right here. So that is an okay buy. And this is also a small high 2. High 1 failed, high 2 here. So you could buy that or buy this. Stop for the bulls is still down here. In any case, if you did short, I probably would get out above this bar or above that bar or above this bar, because this does not look like it's going down very far. It looks like it's going more sideways. You got to look to the left, and here's the context. A very strong rally. We gapped up and we reversed down, but it does not appear that we're falling very far, very fast. So this might end up as a bull flag. Not yet high probability to buy. Higher probability to wait to see if we do get the bull breakout. But if you shorted, I would get out of the shorts. Again, we have a small double bottom and a breakout below the double bottom, reverses up. This is a type of wedge bottom, 1, 2, 3, or you can simply call it a double bottom, which is a type of high 2 bull flag at the moving average. A reasonable buy on the open. Consecutive big bear bars on the open, always in short, but a very tight bull channel. Probably not much down, probably buyers around the moving average. Traders will look for a reversal up from support, and one of the most common supports on the open is the moving average. A sell-off down to support, opening reversal, and then a rally from there. And this little sell-off could put a tail on the bottom of a bull trend day. So if you look at the daily chart, you might see a little tail on the bottom. In fact, most bull bars on the daily chart have tails on the bottom, and they are created by initial sell-offs. Most big bear trend days have little tails on top. They're usually created by early rallies that reverse down. Bull breakout, so a spike, and now we have a pullback, so maybe we'll channel up. And traders will look to buy pullbacks. Another pullback to the moving average here, near the moving average. Traders keep buying as the pullback reverses up. Take a look at this. Pretty strong buy the close finish yesterday. And today we have a gap up, but first 3 bars doji, first 5 out of 6 bars dojis, and then more dojis here. Probably sideways until we get near the moving average. You can see we've got a tight trading range. No rush to buy. You could buy above this bull bar, or you could wait. No good buy signal bar here, despite a double bottom in a small high 2, high 1, high 2. Higher probability to wait for the breakout or follow through, or when it becomes buy the close. So we got a bull breakout of a double bottom bull flag near the moving average, probably at least 2 legs up. And since the market usually has a swing beginning in the first hour or two, and the swing usually lasts 2 to 3 hours, this could be the start of a trend up for the next 2 to 3 hours. In fact, it turned out to be the start of a trend that lasted for the remainder of the day. None of this looks particularly strong. We have a lot of dojis, tight trading range, tight trading range, tight trading range. But high, higher, higher, higher low, higher lows, higher low. We're still in a bull channel. You got to be really careful taking shorts. The pullbacks are not very big. It's better to wait for a pullback, a reversal attempt, and bet that it will fail, and then buy the reversal up. Every attempt to reverse down is another bull flag. So attempt to reverse down, bull flag, look to buy the reversal up. Attempt to reverse down, bull flag, look to buy the reversal up, either here, or after this strong 2-bar reversal on the failed breakout below the moving average. Bears have 2 bear bars. Normally, traders would like to see 3 or 4 consecutive bear bars before they conclude that the bears are winning. And because of that, a lot of times when there are 2 consecutive bear bars, bulls will start buying closes. So they'll buy the closes of that second bear bar, betting that the bears will not get 3. And then also they'll be buying above bull bars on the resumption up here or above that bull bar. Now, we tried to break to the downside, but where is the follow through? So we got 1 bear breakout, but no follow through bar. Instead, we got a reversal up. And in fact, this is slightly above that low. So we're getting a reversal up, and it's a double bottom, higher low. It's better to bet that the bears will fail and that we're going to go higher. And we got a buy the close bull trend near the end of the day. Traders were buying closes. After 5 or 6 buy the close bars, traders have to be ready for a reversal down. And usually you get out below the first bear bar. A similar situation, a gap up and then sideways to the moving average. But in this particular case, it stayed sideways in a tight range all day. Looks like a good start for the bulls. 3 bull bars, 4 bull bars. I think it's always in long on the close of this bar. And then it looks like we have a buy the close rally. The bars are small, plus we have that tail here and tail here. Now we have a bear bar. This is probably going to result in a tight trading range that will go sideways to down to the moving average. And it did. It ended up in a very tight trading range. Tried to break below the moving average, followed through, but reversed up on the next bar. Consecutive bull bars, always in long. You can buy above the high of that inside bar. Here we have a decent sell signal bar, a bear bar closing on its low. Micro double top here and here, small double top. And the rally is weak enough, especially with this tail here and then the small bars and now a bear bar. We're probably going sideways to down to the moving average. So the bulls who bought here will probably get out below that bear bar or anywhere in here. But look at the sell-off. Where are the consecutive big bear trend bars? They got a decent bear bar here, but not consecutive big bear bars. Even though we sold off for a couple of hours, it's more likely a bear leg and what will end up as a trading range, and it did. Bulls see a wedge bull flag, 3 or 4 pushes down, 1, 2, 3, and then 4. They'll buy the reversal up, but stop is below this, the bottom of the bull leg. Bears see a double top, lower high, major trend reversal, bull trend, bear breakout, double top, lower high in a tight trading range. 40% chance we're going to get a swing down. That means 60% chance we will not. And here we got the breakout and follow through, but then a reversal up and a slightly higher low double bottom with the low of the day, the open of the day. So bulls will buy a reversal up. Also a gap bar, a gap between the high of this bar and the moving average. After the market has been above the moving average for 20 or 30 bars, probably will lead to at least a minor reversal up, maybe a measured move up. Yesterday we sold off strongly, and then we ended up with a bull channel into the close. Bull channel is a bear flag, so you got to be thinking about a bear breakout. We tried to get a bull breakout above the bull channel. 75% chance it will reverse down to the bottom of the channel within about 5 bars. Here it reversed down within a couple of bars. Also, we got a buy climax here, a pair of very big bull trend bars. It could be a measuring gap, but because it's breaking above the top of a bull channel, you got to be thinking that it might be a trap for an opening reversal down, 2 legs up, 1, pullback, 2. It's always in long, but this is dangerous. It's possibly a second leg trap, 1, pullback, 2. And since we're getting a bull breakout above a bear flag, and 75% of the time it reverses down, traders will look for a sell signal bar like this bear bar, and they'll either get out of longs or look to sell. Always in long, but we've reversed back into the channel. We've fallen for about 6 bars or so. I would wait instead of buying this. We have a tight bear channel and a target below. Also, anytime you're in a fairly broad channel, you have to assume the pullbacks will be deep. You can see this pullback retraced about 75% of the bull leg, and this one retraced more than 50% of that bull leg. This one will probably get down at least to the bottom of this buy climax. This is a reasonable buy. Bulls will buy that close, they'll buy that close. Most bulls would get out below that bear bar because of the failed breakout above the bull channel. But it's okay to hold long and bet that the channel will continue up. However, we could get a very deep pullback. So if you're buying this bull close, betting that you can buy more lower and it will get back here, allowing you to get out break even on your first entry and with a profit on your second. If you do take that buy, you need an appropriate stop below the bottom of the most recent bull leg. Putting it below the buy climax, I think, is not good. I think you need it below the most recent major high or low. Because it's a decent buy the close rally, traders will look to buy above a bull bar. Would they buy here? 2 legs down, 1 pullback, 2. Well, very tight bear channel, so not good. What about buying this? Leg 1, pullback, 2, micro double bottom. I think this is an okay buy. You're buying above a bull bar, you have 2 legs down, even though the channel is tight. But if you do buy here, your stop is still down here. In general, whenever you have a buy the close market and then a big reversal, a deep pullback, you are looking to buy above a bull bar, either here or here or here. However, you want the second entry to be at least 2 or 3 times bigger than a minimum scalp. Your goal on the second entry is to make a profit, get out around the first entry, break even on the first entry, and with a profit on the second. And in general, I want the second entry to be at least 2 or 3 times the size of a minimum scalp. For example, in the E-mini, the minimum scalp is 1 point. If I'm going to be buying above a bull bar, adding to my position, I want the second entry to be about 3 points below the first entry. And it's a channel. Traders sell every new high. This is a new high. You got some bulls getting out here, break even on the first entry. Others will wait for a reversal down. Pretty good bull breakout, probably at least a little bit more up. And then we have a second entry short, both with bear sell signal bars. I think this is a good exit place, especially since there's not much left to the day. In this particular video, I gave several day trading examples. This is Al Brooks. Thank you again for watching the Brooks Trading course. And this video had swing trading examples. Many of the swing trades turned out to be scalps, which is always the case, but the setups were for swing trades. This is Al Brooks. Thank you for watching the Brooks Trading course. This is the second of 5 videos on swing trading examples. In this video, I'm going to give a series of examples on how to swing trade for day traders. This line is the open of the day. I always look to the left, and you can see yesterday the market was in a tight trading range here and again here. That tells me that today probably will have a lot of trading range price action. We have a reversal up, reversal down, reversal up, down, up, and today is beginning in a way that is similar to that. Markets have inertia. They tend to continue what they're doing, and on today's open, we're continuing all of the reversals and tight trading range trading of yesterday. We have a sell-off on the open, and we have a pair of bear bars, but then a bull bar. Another pair of bear bars, and then 2 more bull bars. A bear bar, a big reversal attempt, and it failed. It reversed down. All the way down, we're getting bear bars and bull bars. We're getting a lot of overlap over here and over here. There's an absence of consecutive big bear bars closing on their lows. There are no clear, good sell signal bars. We have a bull bar and went down, a bull bar, down, bull bar, bull bar, bull bar. These are bad-looking sell signal bars. We have a lot of overlap. The tails are fairly prominent on all of the bars. This looks like it's probably a bear leg in a trading range day. And when you get an open like that, the market usually continues down for 2 or 3 hours like that, and then it goes the opposite direction, a bull leg in a trading range. And because of that, traders look for a swing trade up. Most traders should wait when they see the market behaving like this. Expert traders will scalp. They'll sell below for a scalp, they'll buy above for a scalp. They'll sell bull closes near the moving average, they'll sell above a bear bar, a weak-looking buy setup, betting that will go down. At some point, you conclude that a trading range is likely, and therefore traders will look for a bull leg in the trading range, a reversal up. 3 pushes down, 1 or 1, and then 2 and 3. We broke a little bit below the line, and we're reversing up. And then we get a bull bar closing on its high and another bull bar closing on its high after a wedge bottom and a probable bear leg in a trading range day. Bulls are looking to buy a reversal up. They can buy early here or here, stop down here, micro double bottom. We went down and up and then down and up. Reasonable to buy above the neckline of that micro double bottom and get filled above the high of this bar, or buy the close of the follow through bar here. On this day, we have a big gap down, but a reversal up. But look what followed this big bull bar. It has a tail on top, and it's followed by a doji bar. We have a second bull bar, but a smaller body, and again, a bad follow-through bar, and then 4-bar sell-off. Reversal up, bear bar, reversal up, sell-off. This does not look like the start of a bull trend. It's probably a bull leg in what will become a trading range, or it's probably a rally that will test resistance and lead to a swing down, a bear trend day. Big reversal up. Minimum objective would be a measured move based upon the height of that bull breakout. That would take us here around the moving average. The bar after the bull bar is not a bear bar. That absence of a bear body is minimum good follow through for the bulls, and it means that we'll go at least a little bit higher. Maybe a measured move up, maybe a test of the moving average. But look at this rally. 1 leg up, a reversal. A second leg up, pullback. Third leg up. This looks like a wedge rally around the moving average. And it's also around a 50% pullback from this high to that low. And we have a gap bar, a gap between the low of this bar and the moving average in a bear trend. All reasons to be thinking about a possible reversal down. You can also call it a spike and channel bull trend. Spike, pullback, second push, pullback, third push, or first push, pullback, second push, pullback, third push. Bears are looking at this as a weak rally, probably a bull leg in a trading range day, or simply an opening reversal rally, a rally on the open that reverses down at resistance, a 50% pullback, and around the moving average. The bears are looking for sell, expecting either a trading range day, a sell down to the bottom, or possibly a bear trend day. A decent bear bar, wedge 1, 2, 3, or wedge 1, 2, 3, 50% pullback. Traders will sell below the low of that bar, and they'll put a stop right above its high. Fairly tight channel, a low probability trade, but the risk is small, and the reward is many, many times greater than the risk. So it's a reasonable short. Some traders prefer a higher probability trade, and they'll wait for 3 or 4 consecutive bear bars, with 1 or 2 of them closing near their lows, and then they'll sell the close of the bear bar. Now it's a higher probability bet that will go at least a little bit lower. Again, stop above the top of the wedge. And at this point, we've had 9 bars without a pullback, 9 bars where the high of every bar is at or below the high of the prior bar. Chances are we're going to go at least a little bit lower, and therefore bears will sell at the high of the prior bar and get filled here. Another reasonably high probability short, stop above the top of the bear reversal. After this series of bear bars, 6 or 7 consecutive bear bars and a wedge top, stalling at the moving average, traders will look to sell reversals down from bull reversal attempts, especially at the moving average. The bulls are trying to reverse, bears expect it to fail, they'll sell below the low of the prior bar. Bulls trying to reverse up to the moving average, a double top, up, down, they'll sell below that bar. Another bear breakout, the bulls trying to reverse again, the bears will sell another low one, bear flag. We have a strong breakout here, 3 or 4 consecutive bear bars. Bears will start selling closes, betting that the market will go lower. Here's the open of the day, and yesterday there was a lot of trading range price action. Markets have inertia, and they tend to continue what they were doing before. You always look to the left to get an idea of what the right will look like. While the bears have a good breakout bar in the open, the bodies are getting smaller, 3 consecutive bear bars, and the tails are becoming bigger, and now we have a couple more dojis. Here we have 5 consecutive dojis after the sell-off. This looks like a continuation of this kind of a price action, and it increases the chances that we'll get a lot of trading range price action at least for the next hour or two. Here we have trading range price action for about 70 bars. Early trading range price action after trading range yesterday, chances are we'll have at least an hour or 2 of trading range price action today. That means if we go down, we'll go up, and if we go up, we'll go down. You can look at this as possibly a wedge bull flag, reverse up, reverse up, reverse up, possible low of the day, not a high probability buy. You can also look at it as a big high 2. Leg 1, reversal up, leg 2, reversal up. But we have 4 dojis, here we have 5 dojis. Not a particularly good buy setup. Probably sellers above and will go sideways. The market reversed up and started to reverse down with this bar. This is a double top bear flag just below the moving average. After a gap down, it's a reasonable sell for a possible high of the day. And it became the high of the day. However, you had to sit through a lot of sideways bars before you got the final swing down. If you want, you can call it a triangle, reversal down, reversal down, reversal down, and this would be a triangle sell, again below the moving average. There's a lack of conviction on the part of the bears. We have a series of bear bars, but getting smaller bodies, a bear bar here, then a bull doji, bear bar here and here, but then a bull reversal. This is probably going to be a bear leg in a trading range. It's still a possible high of the day, and it turned out it was the high of the day. Many bears would buy this. We have a gap down. We reversed up from below yesterday's low, and now we have a second reversal up from below yesterday's low with a good buy signal bar. That's a reasonable buy for a possible low of the day. A lot of the bears who sold here will get out. A lot of the swing bears will hold short, keep their stop above the high of this bar or above the high of this bar, and then just wait to see if we get trend resumption down later in the day. Bulls are buying this, looking for a possible low of the day, stop below this low. The bears now have another low, a failed breakout above the moving average. They'll sell again below here. A double top at the moving average, you can call it a wedge. Push up, down, up, pause, up, 4 pushes up, 3 or 4 pushes up makes a wedge. A double top, lower high at the moving average. We're still always in short. The bulls could hold long as well, betting on the low of the day, and you can see they got a higher low here, and it was only over here that the bulls finally gave up. The bears have a reasonable short. The bulls have a reasonable buy. That tells you that the market's going to go sideways. The probability slightly favors the bears because we have a gap down and most of the trading is below the moving average. But it's reasonable to be long, taking a chance on the low of the day. It's reasonable to be short, taking a chance on the high of the day. Most traders would not swing trade. They would just sell, get out, or buy and then get out. If you are swing trading from the short side, we're getting lower highs. We keep failing at the moving average. You sell every reversal down from the moving average, betting that the bull reversals will fail. Small low 2, we went up and down, up, and then sell below that bear bar. We have a low 1, low 2, sell below that bear bar or below that bull bar. And you can call this a low 1 or a low 2, up, pause, 2. Double top is always a low 2. We're trying to reverse up here, small double top there or double top here, a bear bar, look to sell. None of these is a high probability short, but the math is still okay. Everyone wants very clear trading. Most days are not clear. While this is extremely tight, it gives you an idea that most days are not as easy as they appear to be. And you tend to spend a lot of your time taking small trades that do not go very far. The bears are betting that every reversal up will fail, so every time there's a bull close near the moving average, they'll sell the close here, they'll sell more here, they'll sell more here, betting against the bull reversal. This is the same chart. Again, a gap down, consecutive bear bars, therefore always in short. But you can only sell if you can make fairly quick decisions. Here we have a pair of bear bars, but then what do you do once you see bull bars? Instead of a series of strong consecutive bear bars, now we're trying to get a reversal. A lot of bears are disappointed by this, and they'll buy back their shorts above the high of this bull bar, or simply at the market around their entry price, expecting at least a small bounce, possibly a low of the day. If you do take that short and you trade it as a swing trade, you keep your stop above the high until there's a clear, strong reversal. It was a trend from the open, bear trend. Here we have a gap down, and then we entered a tight trading range. A lot of dojis, prominent tails, small bodies, and sideways with multiple reversals. It's in a bear trend, therefore it's breakout mode. When the market's in breakout mode, 50% chance you'll get a successful bear breakout, 50% chance you'll get a successful bull breakout, 50% chance the breakout will reverse. And that's what happened here. We have a bear breakout, it only lasted 2 bars, and it reversed up. If you want, you can call it a triangle, 3 pushes down, 1, 2, 3. I simply call it a tight trading range. We have a bear breakout with consecutive bear bars, but a big tail, and then an II, a lot of hesitation after the breakout. This triangle in a bear trend might be the final bear flag, and it could be the low of the day. This does not look like the start of a strong bear trend day. Where are the consecutive big bear bars closing on their lows? Where is the good follow-through? This is terrible follow-through. We're breaking out, 50% chance the breakout will fail and reverse up, and this will be an exhaustion gap. 50% chance the bear breakout will succeed and will fall for some kind of a measured move, maybe from this high to this low, and we'll get a gap here. A small II, so it's a small breakout mode pattern. Bears will exit above. and bulls will buy for a possible low of the day. Not a high probability buy, but the risk is small relative to the potential reward, so it's a reasonable trade. Some traders prefer higher probability. We have a reversal up here. We went above the top of the final sell climax, and now we have a high 2 bull flag, high 1, high 2, or high 3, and a decent bull bar. Bulls will buy above the high of this bar, or they'll wait for 3 or 4 bull bars closing near their highs, and then they'll buy closes. And then they'll buy bear closes as well, betting the first reversal down will fail. It's a buy the close bull trend, and you can call this a spike, pullback, second push, pullback, third push, pullback, fourth push. So a spike and channel bull trend. Now you look to the left and you say, the open of the day is right around the middle third of the day, and we're around a measured move up from the low to the open. This could be a trading range day. Also, even though we have a strong reversal here, this is not great follow through. We do not have consecutive big bull trend bars closing on their highs, and we're not above all the bars to the left. This could be a bull leg and a trading range day. 16 consecutive bars where every low is at or above the low of the prior bar. That is unsustainable and therefore climactic, and therefore we might get a pullback fairly soon. Because of the possibility of a trading range day, a lot of the bulls will exit below the low of this bear bar, or they'll wait for 2 or 3 bear bars and then exit. Again, the same chart. This rally could simply be a buy vacuum test of resistance at yesterday's low or yesterday's close. And if so, it could end and we could reverse back down. Because of that, some bears will sell below the low of that bear bar, betting that at a minimum will test back to the open of the day. At this point, the open of the day is in the middle third of the day, and we have a lot of trading range price action, a bear leg and now a bull leg. Traders expect the market to get back to the open of the day. It's a reasonable short, especially if they can use a wide stop. Higher probability, wait until you get 3 or 4 consecutive bear bars and then sell closes or sell above the high of the prior bar, betting that the first reversal up will form a lower high and we'll get a second leg down. We have a spike pullback channel, a very tight channel, but still a channel. The market usually tries to test down to the beginning of the channel, down here, and at that point, bears take partial profits. So here, we broke below the bottom of the wedge, and there's some hesitation. Bears took partial profits, and aggressive bulls scalped, betting for at least a small bounce. The market's still always in short. The first reversal up probably is minor, so traders will look to sell from a lower high. Stop above the top of the bear reversal. Here we have a low 2 short, low 1, low 2, micro double top, up, up, and a lower high major trend reversal. Bull trend, bear breakout, lower high, 2 legs up, 1 pullback 2, and a second entry short, a reasonable short. Strong bear breakout below this low, and follow through. Traders will start selling closes, or they'll start selling bear flags. Every time they see a bull reversal, they assume it will be minor and the bear trend will resume. They'll sell a reversal down, a low 1 or low 1, low 2. And here we have another down, up, down, so it's a small low 2 bear flag. We have 3 pushes down, 1 pullback, 2 pullback, 3. It's a parabolic wedge. Parabolic wedge bottoms are less common than parabolic wedge tops, and they're also often less clear. We have a bull bar, but why do we have that tail on top? We have a bull bar here. Why did this bar fail to get above that high? Something's wrong with the bulls. While it's possible this is the low of the day, it's not a very strong looking parabolic wedge buy setup. If you want higher probability, wait to see if we get several consecutive bull bars and then buy higher. Not extremely oversold. The bars are not especially big, and not a parabolic curve down. The third push down did not break below the line connecting the lows of the first 2 legs down, maybe a little bit, but not much. This is not extremely climactic, and therefore it's not yet extremely oversold. And again, a problem. The bulls could not get above this bar, And here they have a buy signal bar, but a big tail on top. This is not a strong reversal up, not a high probability buy. The channel is very tight. Probably the reversal is minor, which means sideways rather than up. That high 2 never triggered. High 1, high 2. The high 1 buy signal bar is only a small bull doji, not strong enough buying to reverse this big bear bar. The bulls are not nearly as strong as the bears. While it's a possible low of the day and an okay swing buy, it's higher probability to wait to see if we get a strong reversal up and then buy higher. The probability for the bulls buying here is not high enough for a scalp. It's okay for a swing, but it's a low probability bet. I usually wait to see if we start to reverse up and then buy after the bulls have clearly taken control. And you can see the bull reversal did not get very far. We have a double top bear flag, this high and that high. And this is a breakout test of that low. Not a very good looking buy. The bulls who bought above this bar or above this bar are exiting on the way down. Instead of getting a series of bull bars, they immediately got bear bars. Chances are we're going lower. We have 4 strong bear bars. Probably we'll get at least a small second leg down. This could be the small second leg down, but I think this is enough strong selling so that we'll get some kind of a measured move down. We're near a measured move, but not quite there, and the reversal up is not strong. A micro double bottom, but a bear bar. The market's probably going to fall at least to this measured move target, and therefore this reversal attempt is probably minor. It probably will become a bear flag. Aggressive bulls will look at it and see another wedge bottom. We had a wedge 1, 2, 3, and they'll say, oh, maybe it's a wedge here, 1, 2, 3. Maybe this is the second leg down after this bear breakout. Probably not. This is a surprisingly big breakout. We're probably going to get a bigger second leg down. Again, a low probability buy, a bad looking buy signal bar, 4 strong bear bars, probably a minor reversal, and we'll go at least a little bit lower. Bear trends are always forming wedge bottoms. Bull trends are always forming wedge tops. When the channel down is very tight, the reversals are probably minor, and these wedges will probably become bear flags, and the market will probably continue down. Here, the buy signal bar has a bear body and a very tight bear channel. This is a low probability buy. Probably the best the bulls get is a trading range, but more likely they'll get at least a little bit more down. The bulls will lose money. Bulls trying to get a high 2, sell off high 1, sell off high 2. They only have a doji. They have another attempt at it here and a bear bar. Big bear breakout, so probably more of a second leg down. Again, higher probability to wait either for a better bottom or a strong reversal up and then buy. Right now, all reversals up will probably fail, become bear flags, and lead to at least a little bit more down. First leg down, pullback, second leg down. We reached the measured move target. We fell a little bit below it. And now you can argue another wedge bottom. 1, 2, or 2 and 3, or 1, 2, 3. Different computers will calculate the legs differently. You can also say 1, 2, or 3. Again, different computers will use different bars, but the principle is the same. You can call it a nested wedge. We have a smaller wedge here inside of a bigger wedge here. That's a higher probability reversal. And a second parabolic wedge bottom, a very tight channel wedge, and it fell below the measured move target. We have a series of sell climaxes here, 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 a 4-bar sell climax here, 3-bar sell climax here. The market probably is going to get exhausted, and the market then will probably have to go sideways for 10, 20, or 30 bars. 10 bars, 2 legs, TBTL, sideways to up is likely. Here we go, leg 1, pull back, leg 2. The market has a complex bottom attempt here. By complex, I mean a high 2 or a high 3. Here we have a high 3, a wedge bottom. And we have a breakout and then another complex bottom, high 1, high 2, or a small wedge. First bottom failed, and now we're getting another complex bottom attempt. Strong enough bear breakout to expect at least a small second leg down. I used to refer to this kind of a setup as a high 4, but so much of the time it's really a high 5 or a high 6. Basically, it's a complex consecutive bottom pattern where you get a complex bottom and then a second complex bottom. And it can be a high 4, a high 5, or a high 6. The first bottom was a wedge, and the second bottom is also a wedge. So this is a high 6. If you want, you can call it a variation of a high 4, or you can call it simply consecutive bottoms, which is what I now call it. The market tried hard to bottom, it failed. It tried hard again to bottom, higher probability that the second attempt will be successful. It doesn't matter if you call it a high 2 or a high 3 or a high 2 or a high 3 down here. The market's trying to bottom in a complex way. We get a bear breakout and then it's trying to bottom again in a complex way. After you have consecutive complex bottoms like this, 60% chance you'll have at least a couple legs sideways to up, which we got. Traders will buy above the high of this micro double bottom, or they'll wait for bull closes and then start buying bull closes. That is a higher probability bet. Either way, they're going to put a stop below the low of this strong bull bar. Here we have a good bull bar, and then we have a second consecutive bull bar. Traders will start buying closes on either this bar or this bar. They can buy closes all the way up as long as they put a stop below the bottom of the bull reversal. A buy the close bull trend. After 3 or 4 closes, bull closes like that, traders will start buying closes, either for a swing trade or for scalps. We're getting a reversal down. It's about a 10-bar bull microchannel, but it's a reversal up from a very tight bear channel. The first reversal up is probably minor, which means we'll probably get a test down and then get a major reversal attempt. Bear trend, strong bull breakout, an attempt by the bears to resume down, yet we're getting a higher low with a decent bull bar, a breakout test of the buy signal bar highs, and about a 50% pullback of the initial rally. 2 legs down, 1 pullback 2. This is probably going to lead to at least a small second leg up, higher low, major trend reversal. Because the first leg up is probably minor, bulls will take profits on a resumption of the bear trend back down. However, a lot of bulls will buy the higher low, betting that it's a higher low major trend reversal, and it is. 40% chance that they'll get a swing up, 60% chance that the market will either go sideways or start to go down. The risk is not big. They buy above the high of this decent bull bar, stop just below, or stop below here, looking for at least a small second leg up. Now we have a double bottom, this low, that low. This is a double bottom, higher low. We also have a wedge. 3 pushes down, 1, 2, 3. So a wedge and a double bottom. Probably always in long after this strong rally. Reasonable to buy the reversal up here. Or if you prefer to buy above a bull bar, many traders do, you buy here. That has a higher probability of success. 2 legs up likely, 1 pullback 2. And we have a lot of trading range price action. This is a bull breakout above a trading range that lasted about 60 bars. Most trading range breakouts fail, and therefore a lot of the bulls will exit, take profits on a reversal down, especially below a bear bar. 2 legs up, 1 pullback 2, and a bear bar, failed breakout above the prior high, failed breakout above the top of the trading range. Reasonable to take profits. Bears see a trading range as well and a breakout, and it's failing. They'll sell for at least a scalp. Again, a parabolic wedge bottom. We tried to reverse up a second time. This bar went above that bar, which is good, and this bar is a good-looking buy signal bar. That increases the chances that we're going to get a reversal up. Here we fell below the bottom of the wedge, the line connecting point 1 and point 2, and we are reversing up. Not a particularly strong buy signal bar, but it's a reasonable buy. Yesterday's low is around here. This is a wedge bottom, opening reversal at support. Yesterday's low, a failed breakout below yesterday's low. Maybe a 40% chance it's going to be the low of the day. Aggressive bulls buy above the high of the buy signal bar, betting on the wedge bottom. Stop is right here. The risk is small. The reward is many times greater than the risk. So it's a very good trade, even if the probability is only 40%. Traders who prefer a higher probability trade wait until we see a couple strong bull bars, and then they'll buy closes. And they'll also buy below a bear bar, betting that the market is now always in long and a reversal down will fail. So they'll buy at the low of this bar and they'll get filled here. And then we have a high one buy. We have a bull breakout of a wedge bear channel. Bulls will buy above a bull bar on the resumption up. These buys all have a higher probability of a profit than this initial buy. The stop is the same, whether you bought here or here. You're taking a higher probability buy here, and the stop is further away. The risk is greater. And that's always the case whenever you take a higher probability trade. You pay for it with worse risk reward, usually a stop further away. After several bull bars closing on their highs, it becomes a buy the close bull trend, and traders can buy at any time for any reason. Some traders will buy and exit. They'll keep buying and scalping. Other traders will just buy once and hold all the way up. Some traders will buy once and then take one or more of these buys to add to their position, scaling into a trade that is going their way. This video shows many day trading examples for swing traders. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 5 videos on swing trading examples. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 5 videos on swing trading examples. In this video, I'm going to be talking about day trading examples, and I'm going to emphasize trade management more in this particular video. We see a bull microchannel, 16 bars without a pullback. By a pullback, I mean the low of the bar going below the low of the prior bar. And this began here. On a higher time frame chart, that's a very strong breakout. However, it's unsustainable. Can you get 20 bars, 30 bars without a pullback? Very unlikely. It's climactic, and climactic usually means the market has to go sideways or down for 10 or 20 bars before the bulls will buy again. If you're buying anywhere in here for any reason, you can buy above a high one, you have another high one buy here, or you can start buying closes all the way up. Any buy that you take anywhere through here, you have a stop down here, and you do not raise your stop. Maybe after 4 or 5 bars here, you might raise your stop to here. The market is clearly still always in long. If you're swing trading, there's no reason to exit your long, whether or not you bought here or here. You're still holding long. And even here, we have a potential final flag and a transition into a trading range. No time in here do the bears do anything to convince traders that they have taken control. And therefore, the bulls are still holding long. We have a 20 gap bar pullback here. We've been above the moving average for 20 or 30 bars. Chances are the bulls will continue to hold long. Even up here, the bears do not have a convincing top. The market has transitioned into a trading range, and it's okay for the bulls to exit and then wait for another buy. However, they do not have to. No matter where they bought, let's say they bought here, they're still long. The market is still always in long, and it's still reasonable to stay long until the end of the session. If you did exit and you're flat, or if you were simply flat for any reason, the market now is pulling back to the moving average for the first time in about 30 or 40 bars. It's reasonable to buy a reversal up, especially over a bull bar, for at least a scalp up. You can call it a wedge bull flag as well. One push down, pull back, second push down, pull back, and then another bear bar, third push down, and now the bulls are trying to reverse up. Since the market's now in a trading range, traders want to buy low, sell high, and when they sell high, they can be selling out of longs for a scalp, taking profits. Not a strong enough setup for the bears to sell, but it's reasonable for bulls to exit longs, whether they bought here or whether they bought here or anywhere in here. Although you don't see all of yesterday, we broke below yesterday's low and we are reversing up. A good looking buy signal bar and 3 consecutive bull bars. The market's always in long. Good looking entry bar for the bulls who bought above this bar. Big bar closing on its high, bigger than the bear bar before it. Consecutive strong bull bars. By strong, I mean closing on their highs. Failed breakout below yesterday's low. The market is now always in long. And by that, what I mean is the market's probably going at least a little bit higher. The follow-through bar after this strong bull bar, a little bit disappointing. The body is not particularly big and it has a fairly conspicuous tail on top. That is a warning that this rally might in fact be a bull leg in what will become a trading range. Maybe we'll get one more push up to the moving average and form a wedge opening reversal. Reversal down, maybe a third reversal down at the moving average. It's reasonable to buy this bull bar closing on its high. You buy on a stop above its high and you get filled right here. Bulls buy on a stop above the high of this bull bar and they get filled here. This is then the entry bar. Most bulls should be entering on a stop above the high of the buy signal bar. Aggressive bulls would buy the close. I think most traders should enter on a stop above its high. The context is good for at least a minor reversal, in other words, a few bars up and possibly a trading range, but it might be the low of the day. As the bar is forming, it's going up reasonably strongly. A lot of bulls who did not buy the close here or the high of that bar right here will buy as the bar is forming, betting that the momentum up will result in higher prices. When you're taking these early buys, your stop is right below the low of the bar, so your risk is small, but your probability is low as well. However, after you've had 2 or 3 good bull bars, the probability is higher that the market will go higher. If you buy at this point, your stop is now further away, and that's always the case. If you wait until the probability is higher, the stop is further away, so the risk is greater. That is acceptable, just as it is acceptable to take the early entry above the high of this bull reversal bar. Get long right here. By having a second consecutive bull bar closing on its high, and now a third consecutive bull bar closing on its high, the bulls have demonstrated that they're in control. The probability is the first reversal down will be bought. The bulls will buy it, and not many bears will sell it, and will go at least a little bit higher. Bulls buying closes, they buy this close, they'll buy that close as well, betting that there'll be at least a 60% chance of some kind of a measured move up based upon the height of the breakout. Maybe the open of this bar, the close of this bar, or the close of that bar. More aggressive bulls will even buy with limit orders below the low of this bar, betting that it's a bad sell. For the bears, a double top, this high, that high, but 3 consecutive bull bars, a reversal up from below yesterday's low, 3 bars closing above their midpoints, 2 closing on their highs. This is a low probability short. The bulls know that, and bulls who did not buy earlier will buy with a limit order at the low of that bar, and they'll get filled right here. This smaller bar, this tail, and the bear body means that the momentum is waning. The momentum for the bulls is less, and that increases the chances that instead of a bull trend, this might be a bull leg in what becomes a trading range. There's room to the moving average, which is a magnet, and also room to a measured move target from this open to that close. That takes us up around here. We're probably going higher, but not necessarily a lot higher. It does not matter if you bought the close of this bar above its high here, this close, this low, the stop is right here. You're holding long for at least a little bit more up. The bulls who bought are betting on at least a bull leg in a trading range and possibly a bull trend. They know the odds are that we'll get at least one more leg up and not a bear trend at this point. It can become a bear trend, but it's not likely. Stop down here. The market's always in long, so the bulls will hold long and rely on their stop. If it gets closer to the moving average, the bulls will be thinking that we might get an opening reversal down from the moving average, maybe a wedge rally, 1, 2, and 3. But right now they believe we're going at least a little bit higher. Other bulls will look at this and say, okay, suppose we sell off. We're trying to reverse up strongly here. There probably will be more buyers below this low than sellers. Those bulls are trading small, buying for any reason, and they'll buy more at the low of this bar, betting that there'll be more buyers than sellers here. You'll have a lot of bulls getting stopped out here, but you'll have stronger bulls buying at that low, betting against a bear trend, betting that there's enough buying here so that any reversal down will not get very far before we test back up. Those bulls who are looking to buy at this low will use a wide stop, maybe based upon a measured move down from the height of this opening range. Maybe even further. The bulls who bought, for any reason, here or here or here, now have a new low. Most traders who bought for any reason would stop themselves out below the low of the buy signal bar. Aggressive bulls would, in fact, buy more. They'll see a bear bar here, bad follow through for the bears. A bear bar here, not a particularly big bear bar. They think that the sell-off is probably a bear leg in what will become a trading range. A lot of the bulls who bought would exit on the double top. This high, that high, a low 2, low 1, low 2. But the bulls who did not exit would exit either below this bar or using some kind of a wide stop here or lower. We sold off, we rallied, we sold off, we rallied, we sold off. Multiple reversals, probably a trading range. Again, some bulls would exit on the low 2 triggering in a bear trend. We're below the moving average. Not a very good sell signal bar. More likely, we're going to go sideways. We have small bars, multiple reversals. It looks like the development of an early trading range. Some bulls would exit on the close of this bar or on the close of that bar, if not below that low. But if they do exit, they'll look to buy a reversal up, betting that it's a trading range and not a bear trend. Again, you can exit on a stop below the low of that bar, the low of the original signal bar, or on the close of the follow-through bar. We have a small bear close after the breakout to a new low. Now, I mentioned that some bulls will look at this and say it's probably a trading range. It goes to a new high and it gets sold off. It goes to a new low. It's probably going to rally. There are bulls, especially expert bulls, who will buy with a limit order at the low of this bar, arguing we got a bear reversal but bad follow through. We have a bear reversal and then only a small bear bar here. Probably we're not going down much more. This is probably a bear leg in what will become a trading range. In a trading range, bears look to sell at prior highs. They sell here, and bulls look to buy at prior lows. They buy here, and they buy more lower, betting that this is a bear leg in what will become a trading range rather than the start of a bear trend. You can call this a double top. You can call this a double top. We have a low 2, low 1, low 2. The bears are hoping that this double top is the high of the day. But look at the sell signal bar. It's a bull body, and we have 3 consecutive bull bars. That is a low probability sell. You have a low 2 short, low 1, low 2, but a doji bar and a 5-bar tight trading range. Again, a low probability short. And therefore, it increases the chances that any sell-off will become a bear leg in a trading range. Bulls will be buying below the prior lows, and they'll be buying reversals up. The bears who sell either below here for a low 2, low 1, low 2, double top, or here, double top here, know that we have 3 consecutive bull bars, and we're not at important resistance, the moving average. This is a lower probability short. They'll sell, hoping that it's an opening reversal down from resistance, the moving average, but they know the probability is low. The bears who take this short, some will put a stop right above the high of this signal bar. 3 consecutive bull bars, I would not. I think you need a wider stop. You could put a stop way up here above the high of this rally, or you can put a stop slightly above a measured move up from the opening range. This low, that high, measured move up, and then stop just a little bit above. The bulls have a reasonable argument, probably a trading range. The bears have a reasonable argument, opening reversal, and then a double top bear flag, possible high of the day. Whenever both the bulls and the bears have reasonable setups, the market is probably going to go sideways. Good reversal up, bad follow through. We sold off to a new low, but terrible follow through here, and really not very good follow through here. Therefore, this is probably a trading range. Bears will sell the low 2 short, low 1, and then low 2. They'll sell the strong bear close. They'll sell the breakout below the low of the day. They'll sell the follow-through bar after the breakout. That is a disappointing breakout bar. It did not close at a new low, and it has a fairly prominent tail and a small body. This is a disappointing follow-through bar. It's a small bear doji. The bears who are selling are concerned that this is not very bearish, and it might be a trading range instead of the start of a bear trend. A lot of bears, instead of taking these shorts, which are low probability, will wait for a strong bear breakout and then sell. After that strong bear breakout, the probability would then be higher that we're in a bear trend. The bears who are shorting for any reason, once we have a breakout to a new low and a pretty good bear bar and follow-through bar, this is a major lower high. They'll put their stop above that high. A bad sell signal bar for the bears is only a doji, and bad follow-through after a reasonably good bear bar. The bears know this is more likely a trading range than a bear trend, but the math is okay to swing a short. They take any of these shorts, stop up here, and they hold short looking for a swing down. If the bulls get a reversal up, the bears will get out before the market reaches their stop. For the bulls, they have a rally on the open, and they have a high 1 buy when the market went above this high, and they're hoping for a high 2 buy. Even though this low is below the bull breakout, it still could be a deep pullback from this initial rally. Sometimes you'll have a sell-off after a breakout, and the sell-off goes below the bottom of the rally, but it's still a pullback from that breakout. So sometimes the pullback goes below the bottom of the initial rally. Therefore, bulls will be looking to buy a reversal up, either as a pullback from this rally, in other words, bull breakout, bull flag, or as a low in a trading range. The bears know they do not have good sell signal bars here or here, and the bear entry bar is not particularly big, and the follow-through bars are weak. They are concerned that this looks more like a trading range than a bear trend. They will therefore be quick to exit if it starts to reverse up. And that's what it did. We have an outside up bar closing on its high, and the bar after it has a bull body. This, in fact, a lot of traders will see as a wedge bull flag. 3 pushes down. 1, pull back, 2, and then pull back, and then 3, and then a reversal up. You can call it a wedge pullback from this initial rally. You can call it a wedge lower low. You can call it a double bottom or slightly lower low. In any case, once we're up here and right here, we're probably always in long and we're probably going higher. The reason this bar looks like this is because the bears who did sell down here are giving up. They did not want the market to go up, especially after bad sell signal bars and bad follow through. Again, you can call it a double bottom or a slightly lower low double bottom, and you can call it a wedge, 3 pushes down. In any case, it's a buy setup, and the bulls have a strong bull reversal. When the bulls see this outside up reversal from the wedge bottom and the lower low reversal, they'll buy closes. They'll buy this close. And then once we have one more bull close, they'll start buying closes here, that close, this close. They'll buy a breakout above the top of the bear sell-off, the final bear sell-off, betting that the bears will give up. The bears who were short and did not exit earlier will get out above the high of this bear bar. The bears are exiting and the bulls are buying, betting that we're always in long and will go higher, maybe up to yesterday's close. Not good follow-through after the strong bull reversal, but the next bar has good follow-through closing on its high. So the odds still favor higher prices, even though we're simply pulling back to the moving average. We gap down and we're sideways to the moving average. Here we have 4 consecutive bull bars, 2 closes at a new high of the day, 2 closes above the moving average, and 2 decent-sized bull bars closing on their highs. The market's always in long, probably by the close of this bar. It's easier, therefore, to make money looking to buy. The stop for any of these buys is below the bottom of this bull reversal. Minimum target, you're looking for a measured move up based upon the height of the trading range. Initially, I use the smallest dimensions of the range, this low, that high. If it goes above that line, then I'll look at a measured move from this low to that high, which would be a little bit higher. This bar represents the bears giving up and the bulls getting confident. If you want, you can call it a lower low major trend reversal. We have a bear trend, a bull breakout, and then a lower low. You can also say it's a minor reversal. We only have 3 bars up and a gap down. Not a very big pattern, and therefore it might be minor. In any case, it's still always in long, and the odds are we're going higher. Again, even though we sold off to a new low of the day, a lot of traders will look at this sell-off as simply a bull flag, a pullback from this rally, even though it's at a new low. This is probably going to remain the low for the next several hours and possibly the low of the day. We have a gap down, we reversed up, and we're trying to reverse up a second time from below yesterday's low. This is a reasonably good buy setup. If you break below yesterday's low, we gap down, and you try to reverse up twice, usually the market will try to get a swing up. And you can see we continued up further, and what happened once we reached the measured move target? We pulled back. Why did we pull back? Because a lot of the bulls who bought for any reason are taking profits around the measured move up from the initial trading range. Aggressive bears might take that short and scale in higher, but when the reversal up is as strong as this is, most of the selling is simply profit taking from the bulls. Most bears will not sell because we're probably only going to pull back for a bar or two and probably not far enough to make a profit if you're selling. Again, buying for any reason, stop is below the bottom. This early trading range trading, down and up and down and up and down and up, increases the chances that we'll have additional trading range trading later in the day. Also, we have a bull bar and a doji. A bull bar not all that big and 3 small bars. A bull bar and bear bar. Bad follow through on the way up. Even though we're clearly always in long, that bad follow through after every good bull bar and this early trading range trading increases the chances that this will soon evolve into a trading range. Possibly a parabolic wedge, we have a breakout and a pause, a breakout and a pause, a breakout and a bear bar. Not really good shape, but it's possibly a parabolic wedge top. It's also possible that it's a second leg trap in a trading range day. First leg up, pause, second leg up. It's okay to exit longs below this bear bar, just in case it's a parabolic wedge and we sell off for the rest of the day. It's okay to stay long, but if you do, the stop is all the way down here, not simply below the low of this bull bar. It's an expanding triangle. We sold off from a higher high, and sold off from a higher high. But a very tight bull channel, that is a low probability short below the low of that bear bar. More likely the bulls will get at least a small leg up. Therefore, probably buyers below the low of this bear bar and at least a little bit more up. However, we have early trading range trading and bad follow through after every bull bar. This might end up being a bull leg in a trading range. And if it is, we can get a very deep pullback and still be in a trading range and not a bear trend. Because of the weak follow through after the bull bars and the early trading range trading, a lot of bulls will exit below the low of this bear bar for a failed breakout. Other bulls will hold, stop down here, bottom of the bull trend, and look to add on lower. They believe that if we sell off, the worst what that will happen is we'll get a bear leg in a trading range, and therefore if they hold long, let's say they bought this close, and they hold long, they can buy more lower, confident that the odds are we'll get back up here before we fall below here, so they rely on their stop. Bear scalpers, they might sell below the low of this bear bar, arguing on a parabolic wedge, 3 pushes up, 1, 2, 3, and a failed breakout above the top of the trading range, and a lower high compared to yesterday's high. It's really not a very good looking sell, but it's a reasonable sell, especially if you can use a wide stop, maybe a measured move up, and sell more higher. I said not a high probability short. We have a lot of bull bars in a very tight channel. Higher probability to wait to sell after we see 3 or 4 bear bars or after we see a new high and a reversal down. Look what happened here. Strong bull trend, bulls bought the close, disappointed by these 3 bars, especially the 2 bear bars. And then look what happened when this bar got near that close. The buy the close bulls who bought here were disappointed by these 2 bear bars, and they immediately placed limit orders to get out at their original entry at this close, maybe a little bit below. And when the market got to their sell orders, remember they're long, they're looking to exit, it sold off. These 2 consecutive bear bars have reversed this bull breakout, and now we have big up, big down, big confusion, trading range likely. It's possible that this is the high of the day and that we just trade down for the rest of the day. More likely we'll form some kind of a higher low and try to get back up here later in the day. We're probably always in short. The bulls who bought this close gave up on this bar, and now we have consecutive bear bars closing on or near their lows. We're probably going at least a little bit lower. Some of the bulls who bought for any reason and the bulls who are flat are looking to buy, and some of them will place a limit order to buy a 50% pullback from this low to that high. They'll look to buy with a limit order somewhere in here. Other bulls, let's say you buy this close, are looking to buy above a bull bar, maybe above this bull bar, maybe above this bull reversal bar. Potential small final flag and wedge. Down, up, and then down, up. Very tight bear channel, and therefore the reversal up will probably be minor and will probably end up in a trading range. Big up, big down, big confusion, probably sideways. We got a little bit more down and then we entered a tight trading range. For the bears, we're selling off and now we have a small double top. It's a sell-off, a bear trend, always in short, maybe by this close. Therefore, this is a double top bear flag. You can also call it a wedge. 3 pushes up, 1 pullback, 2 pullback, 3. Does not look like a wedge, but the computers see it as a type of wedge. Bears know we're probably always in short, and therefore they'll look at any rally as a bear flag and they'll look to sell a reversal down. They might sell below the low of this bar for a double top bear flag, a bear body, not particularly strong bear body, but still a bear body. We have a good rally and a buy the close rally. Even though the bulls could have gotten out here around break even, maybe a small loss, usually when you have a sell-off that does not look particularly strong, it'll be followed by a test back up, and this will end up as a trading range. Big up, big down, big confusion, trading range. Trading ranges go up, they go down, and they go back up. The bears have a breakout and follow through, but this looks like a 20-bar tight trading range, not particularly bearish, and therefore bulls will be looking to buy a reversal up. Is it a wedge? 3 legs down, 1 pullback, 2 pullback, 3. It's not really, but it's still 3 attempts to sell off, and each attempt has failed. And here we have a bear bar and a follow-through bear bar, and then a bull bar. This looks like a bear trap, trapping bears into selling below the bottom of this trading range, betting that we'll get down to a new low of the day. And the bulls bought that bear close, betting that the bears would not get another bear bar, in other words, bad follow-through, and they'll look to buy the reversal up. If you buy for any reason, here or here, below the low of this bar, this close, your stop is still below the low of the bull reversal until the market breaks below it, or until it becomes clearly strongly bearish. We became a little bit always in short here, but probably this is going to result in a small sell-off and a higher low. The bars are not all that big compared to the bull bars, and even though we have a bear breakout and we'll probably get some kind of a measured move down, we're probably not going to get below the low of this bar. The market after the sell-off is probably in a trading range. The bulls who bought for any reason know it's in a trading range, and they'll therefore look for rallies that reverse down and they'll get out. Some bulls who bought this close, very disappointed by this, but they held long, stopped down here. And they'll look to buy more above a bull bar, maybe this, maybe that. Let's say they buy above this bull bar right here. This is their average entry price. They bought here, they bought more here, and this is the midpoint of those two prices. A lot of the bulls who did take that buy are disappointed by how much selling that we've had. They're looking to simply get out break even, and they'll get out with a limit order right here at the midpoint of their two entry prices. Other bulls would have bought above this bar, and their midpoint would be a little bit higher. In this video, I gave some day trading examples and I tried to be more specific about how to manage trades. I'm Al Brooks. Thank you for watching the Brooks Trading course. This is the third of 5 videos on swing trading examples. This is Al Brooks. Thank you for watching the Brooks Trading course. This is the 4th of 5 videos on swing trading. In this video, I'm going to give some more examples of swing trading for day trades. Here we have a gap down and a rally that has pullbacks every few bars and a lack of consecutive big bull trend bars. Bull bar here, doji. We have a couple bull bars here, but not all that big. We have a gap down, and now we have a reversal up, an outside bar. It traded below the low of the prior bar, and then above the high of the prior bar, and it closed above the high of the prior bar. And now we have consecutive bull bars. The market's always in long at this point. Higher prices are likely. A lot of traders will buy the close of that bar, put a stop below its low, and hold on as long as it remains always in long. No reason to get out at any point up to here. It's still always in long. At this point, we've had 4 bars without a pullback, and we've had 6 bars without a bear body. These 4 bars without a pullback make this a trend from the open bull trend, even though it began on the second bar. However, doji, 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 and doji here, of those first 6 bars, 5 are dojis. That is not a strong trend, and after this good-looking bull bar, we have bad follow-through. Good bull bars, but look at the follow-through after every good bull bar. Not good. The gaps close. We have a gap, this closed that high, and it closed. We gapped here, this closed that high, and it closed. And the same here, closed above this high, but the gap closed. The bulls see this as a spike pullback channel, 3 or 4 pushes up, 1, 2, 3, 4. It's a weak rally, but still always in long. Look at this. If you're a bear and you look at this and see 5 bars up, 4 are dojis, you might think probably bull leg in a trading range, and therefore you sell at the high of the prior bar, and you sell more higher, looking for a scalp. If the market falls back below your original entry price, you can get out break even on your first sell and with a profit on your second sell. These limit order bears are making money. They sell here with a limit order at that high, they sell more higher, and it comes down to their original entry price. The limit order bears are making money. Typically, if it's a strong bull trend, it's very difficult to make money selling above prior highs and scaling in higher. Limit order bears selling at this high can scalp out. Limit order bears selling at that high can scalp out. They sell here, sell more higher, comes back to their first price. They can get out break even on their first and with a scalp profit on their second. We have a bull trend, but we're also in a gap down and a sloped down moving average. You can argue that this entire rally is a bear flag, a bull channel after a gap down. So it could be a gap spike and then pullback and then trend resumption down. Now we have gap bars, gaps between the low of the bar and the moving average. And therefore, we might test back down to any of these higher lows. 5 dojis in the first 6 bars, bad follow through after every bull bar, limit order bears making money during a rally. Those are all signs of trading range price action, and they increase the chances that there will be a lot of trading range price action today. Therefore, traders will look at this rally and conclude it's probably a bull leg in what will become a trading range. And if it's a trading range, the bulls will look to take profits earlier than they might otherwise. If you have a bull leg in a trading range requires bull and bear legs. Chances are there'll soon be a bear leg in a trading range. Typically, a trading range has legs that last about 2 hours, maybe 3 hours, so 20 or 30 bars. And this has gone on for more than 20 bars at this point. And this is what followed. We have a bear bar and a follow-through bear bar. This is a sign that the final bulls gave up. If they did not exit below this bear bar or below this bear bar, this is telling us that they exited on that bear bar or this bear bar. This is probably the start of a bear swing in a trading range day. The bulls have bought this close. I think they have to get out below the low of this bear bar or the low of this bear bar. This is good enough so that the market would probably get at least a small second leg up. But this little rally above the high of this bar might be the end of that second leg up. And now we have a micro double top and we have a weak rally with 3 or 4 pushes up. 1, 2, 3, 4. It's probably a bull leg in a trading range. And after 3 or 4 legs up, we'll probably soon get a bear leg in the trading range. And therefore the swing bulls who bought here, original stop here, will get out either below here or below here. For the bulls, can they argue that this is a higher low major trend reversal? We have a bear trend and a bull breakout of the bear trend, and now we have a higher low. But it's a higher low coming in an endless pullback, a tight bear channel with a lot of dojis, not much buying pressure. Yes, it's a higher low major trend reversal above this bar, above that bar, above this bar, above this micro double bottom. But when the channel is tight like that, it's a low probability buy. More likely, the best the bulls get is a minor reversal in a trading range or a bear flag. You can argue wedge 1, 2, 3 or 1, 2, 3, 4. And we have a bear sell signal bar. Bulls will take profits there and bears will sell there, or because they think the bull rally will result in a trading range, they might wait for a second entry sell and sell below this bar. Some sold there and some sold below this bar, second entry short. Higher probability to sell after you see a bear breakout bar and a bear follow through bar, which is often small. You could sell here, you could sell below this bear bar here. Those are not high probability sells. But once you have a decent sized bear bar and a follow through bar, and the context is good for a swing down, it's higher probability to sell here, even though your stop is further away. And the bears who sell here are looking for a swing down. They're selling fairly low below the high, so their risk is relatively big. They sell, let's say, that close and stop above this bear bar or above the high of the day, and they just hold through all of these reversals up because none of them was enough to make the market always in long. Some bears will sell the close of the bear breakout. Most bears like to sell the close of the follow-through bar, or even sell above a bar, betting that the first reversal up will fail. The bears taking the sell are selling for a swing. The probability is not high enough for a scalp. Selling here, stop up here. You have to risk too much to take this for a scalp. It's a reasonable swing trade. We're breaking below the bull channel. The bull channel was probably a bull leg in a trading range. We have a wedge, 3 or 4 pushes up. We're probably going to get at least a couple legs down. 1, pullback 2. We might trend down for 3 or 4 hours. Some bears, instead of selling that close, will sell above the high of this bar or above the high of any of these bars, betting that they are bad buy signals and that the market went always in short on the close of this bar. And all of these reversal attempts probably will result in a lower high and then lower prices. Some bears will also sell the close of a bull bar, thinking that the bulls need at least a couple consecutive good bull bars to convert the market to always in long, and therefore they'll sell the close of one, especially near the moving average, betting that the bulls will not get two. They sell that close, again, stop above here, and they just hold on until either the market clearly becomes always in long or until the end of the session. The bears who did not sell here could sell below this bear bar. It's a failed bull reversal and a lower high. Again, consecutive bear bars, decent size, closing near their lows. We're more than 20 bars into the bear leg. This breakout could be a measuring gap. It could lead to a measured move down. The bulls were hoping for a higher low major trend reversal. The gap down is a bear trend, and this is a bull breakout, and they're hoping this is a higher low. They can buy there, but they'll probably give up below that bear bar or second or third failure and reversal down. And these two consecutive bear bars make it likely that we're going lower, maybe a measured move down from this high to that low. For the bulls, this bear breakout is forming a wedge bull flag. 3 pushes down, 1, 2, and 3. You can call it a double bottom over here, this low, that low. They can buy for a swing up, and the bears can be holding short. They sell here, stop above here. Some bears will exit here. We have a failed breakout below this low, a possible trading range, and a reversal up. It's reasonable to exit here. We have a micro double bottom. You expect a second leg down after this, so 1, pull back 2. We try to reverse up. We're trying to reverse up a second time. It is reasonable to get out of shorts either above this bull bar or above this bull bar, which would be about break even there. Bears could also continue to hold short and rely on a stop above the most recent major lower high, which is here. Bulls, they could buy this hoping for a swing up, but when a channel is this tight, I like to wait for a strong reversal up and then buy, and this is just not strong enough. The bears who do exit here will look to sell again below a bear bar. We're still always in short. That means traders still believe it's more likely that we're going to go down than it is that we'll reverse. The bulls have not yet done enough to take control. We're still forming lower highs. And therefore, if the bears do get out, they have to sell again below a bear bar, like below this bar, get short here, below that bar, get short here. After a breakout like this and a lower high, a lot of traders will put their stop here instead of up here. Again, if a swing bear sold here and they exited on the second or third reversal up, 1, 2, 3, they have to be prepared to sell again below a bear bar, unless the market becomes always in long. This is not enough yet to make it always in long. It's a weak bear channel. We keep getting reversals, and traders buying at the low and adding on lower are able to make money. This is probably a bear leg in what will become a trading range. But if the bears did get out here, they'll sell again on a reversal down. We have a bull bar, a bear bar, a pair of bull bars, a bear bar, a bull bar, and then a bear bar. So this is a slight wedge lower high. You can also call it a double top with that high. It's certainly below your stop. And a lot of bears will look to sell again on a reversal down, either here, arguing wedge, 1, 2, and then 3, or they'll sell below bear bars. And you can see a lot of traders sold here. Selling below the bear bar, or selling the breakout bar, betting that we'll get at least a little bit more down. Therefore, swing bears who sold for any reason here, or here, or here, or here, are holding short until there's a reasonably good reversal up, or until the end of the session. A big bear breakout and a good follow through might get a measured move down, but it's the strongest pair of bear bars more than 20 bars into a bear trend. Therefore, this is more likely an exhaustive end of the bear trend than it is the start of a measured move down. So you have to be prepared for a reversal up. We're getting a bear breakout of a bear channel. Usually that fails within 5 bars or so. Usually there's at least a small second leg down after a strong breakout like that. And this meets the minimum requirement. We have a bear breakout and a pause, and then we have an attempt at trend resumption, even though it's small. This might be the second leg down. So first leg down, a pause, a doji bar, and then a small second leg down. And now we're trying to reverse up. If you're a sell the close bear and you sold this close and you see this bull bar, what are you thinking? You're thinking, gosh, that's not what I wanted. I don't want a reversal on a breakout to a new low of the day after a bear breakout below a bear channel. Sell the closed bears will give up. They see a bull bar here closing on its high. They'll buy back their shorts above. And aggressive bulls will buy as well for a failed breakout below a channel, a failed breakout below the low of the day. And this is probably a bear leg in a trading range, which means that after it goes down, it will go up. Close on the high, micro double bottom. Went down on this bar, up on this bar. Down again, up again. So a micro double bottom, failed breakout low of the day, failed breakout below the bear channel. I think the bulls will buy, and certainly the bears will finally exit here. Too much risk of some kind of a swing up. If you want higher probability, instead of buying above this bull bar, you wait for 3 or 4 consecutive bull bars, and then you buy closes. The swing bears who sold for any reason, either up here or here, If they get out here and they sold again here, they get out either above this bar or on the third bull close. And the swing bulls who want higher probability wait for 3 or 4 bull closes and then buy the close looking for 2 legs up, 1, pull back 2. The bulls who bought after a reversal up like this, they'll put their stop down here and they'll hold as long as the market remains always in long. It probably became always in long on the third bull close, meaning that the market was probably going at least a little higher. We're getting a reversal up from a breakout below a bear channel and below the low of the day. And now we're getting a buy the close rally at the end of the day. Bulls will buy closes. Most bulls will not buy every close, but they'll try to buy at least one close and then either hold until the end of the session or until there's a good reason to exit. Some will buy and buy more 2 or 3 buy signals later. For example, they might buy here and hold long and then enter their position here or here, stop down here, looking for a swing up, and then they'll exit at the end of the session. A lot of bulls exit below a bear bar. If you have a bear bar closing below its midpoint and you have a buy the close bull trend, a lot of the bulls will get out below the low of the bear bar, because sometimes you'll get a violent reversal down. Other bulls know that we're getting a bear break below a bear channel and we're reversing up. 75% chance we're going to the top of the channel. And therefore, they'll hold long even though it trades below this bar, because this did not quite reach the top of the channel, and they assume that we'll get there. If bulls do buy closes and they know the market's probably going to touch the top of the channel, their final buy has to be at least the size of a scalp below their target, because the market might reach their target and reverse down, and they want to make at least a scalp profit. And therefore, if the market is near a magnet, you don't want to buy unless the distance between your entry price and the target is at least as big as a scalp. You can argue this is buy the close as well as all of these bars, and it is. But we have a bigger bar, a buy climax. We're getting a buy vacuum up to resistance, and now we're very close to resistance. A lot of bulls will not buy that close to resistance because other bulls will be taking profits and aggressive bears will sell, betting that there'll be at least a pullback from resistance. This is not a good buy the close bar because it's right next to resistance. Today we have a gap up and we have a doji bar, and a bull bar not too big, and it's followed by a bear bar. The bears tried to sell off, and now we have a couple dojis. Can you buy above this bar or above this bar? I think it's probably better to wait for more information. We gapped up, we have a bull bar, it traded a little bit above the bull bar, it traded above that doji, but it immediately reversed down. That is not very bullish. For the bears, we traded below the low of the first bar, a failed breakout of yesterday's high, and then we now have a second sell signal bar, and we're trading below its low. So this is the second reversal down from above yesterday's high, and it's a decent sell signal bar. This is a reasonable short for a possible high of the day, even though initially we're getting bad follow-through. Three consecutive bear bars, 2 with closes on their lows. The market's always in short. 60% chance that there'll be sellers above the high of the prior bar, here or here, and that we'll get at least a little bit more down. Once we get that third consecutive close, some bears who did not sell below this bear bar will conclude we're always in short. They'll sell the close of the third consecutive bear bar. Others will sell the reversal up, especially with a weak buy signal bar, betting that it's a weak bull flag, probably more sellers than buyers above the high of this bar, and that will trade down. It does not matter where you shorted, below this bar, selling that close above the high of this bar. Your stop is above the top of the sell climax, the top of the bear breakout. And you hold short until there's a clear buy signal or until the end of the session. Here we're selling off for about 20 bars, but we're not getting consecutive big bear bars. We could get some decent sized bear bars here, here, and here, but look what followed. The follow through is bad, not particularly bearish. So this sell-off is probably a bear leg in what will become a trading range, which means it'll probably be followed by a bull leg. There's something interesting about this. We have a bear breakout, and then look at this high. It barely pulled above the breakout point, this low or that low. We broke again to a new low, and pulled back here, did not get above the breakout point there. It did get above this breakout point, but it looks like we're getting a gap there, or a slightly negative gap, very little overlap. When you get a weak bear trend like this with bad follow through, but you're getting gaps or negative gaps, gaps where there's slight overlap, you have to be thinking about the possibility that this could become a small pullback bear trend that could last all day. These gaps and negative gaps are important, and they increase the chances that even though this is a weak sell-off, it might be an endless sell-off and the early part of a small pullback bear trend. And eventually we get a breakout and a very tight bear channel, a relentless sell-off. So traders who sold here or here relied on their stop, or if they sold here, a double top here, double top here, they hold short. At some point, after a number of bars, maybe here, they tighten their stop to here, and they just hold on until the market is likely to reverse. A lot of dojis, bars with very prominent tails and small bodies, but we're getting gaps, and that is a warning that as weak as the bear trend appears to be, it might be much stronger than what you think. Whenever you have a leg that looks like a bear leg in a trading range, but you're getting gaps or negative gaps, you have to be thinking that it might be a bear leg in a small pullback bear trend. Pullback small all day, and the trend lasts all day. Again, the bulls are trying to reverse here. They could not close the gap. They could not get above the breakout point, and then they sold off there. This looks like a small pullback bear trend, and it could last for the entire day. So better to hold short. We're trying to get some kind of a bottom, maybe a wedge bottom, maybe a failed breakout below a double bottom. But instead of going above the breakout point, we turn back down. Now we have a bear bar, consecutive bear bars, one of the bars being relatively big. We're probably going to get a measured move down. This is probably going to be a measuring gap from this high to that low. Traders will either sell the close of the breakout bar or the close of the follow-through bar. Or they'll sell for any reason at the market above bars, sell bear closes, sell bull closes, and use the stop maybe up here at this point. Some bears will sell at the high of the prior bar, betting that it's a small pullback bear trend, and therefore pullbacks will probably only last 1 or 2 or 3 bars, and then the bear trend will resume. So some bears place limit orders to sell at the high of the prior bar. Again, stop above the most recent strong bear leg. Now we're starting to get consecutive closes in a very tight channel. Some bears will just sell closes, any closes. Here are 3, but they could sell any close. They could sell at the market. Other bears prefer stop entry, shorts, so they'll sell below low 1 and low 2 bear flags. Here we have a small double top bear flag. Therefore, this is a low 2, and they'll sell below the low of that bar. Here we're trying to reverse up. Therefore, it's a pullback, and it's a low 1 short below its low. Again, here, small double top, 1, 2. This is a low 2. Here we're trying to reverse up, and instead we broke to the downside. So therefore, it's a low 1. Traders do not take all of those trades. Many traders will just take one, especially early on, rely on their stops, and then swing trade until the end of the session. Now we're getting extremely strong selling, but about 70 or 80 bars into a bear trend. Is it more likely that the bear trend is suddenly becoming stronger, or that this is a final exhaustive sell climax? More likely after 20 or 30 bars in a bear trend, if the trend starts to accelerate and get the biggest bear bars of the entire bear trend, it's a sign that the bear trend will exhaust and reverse. Now we're getting a micro double bottom, down, up, bull bar closing on its high, bull bar closing near its high. The final bears will exit above this bar, arguing probable exhausting sell climax late in the bear trend. And the bulls will buy with a stop, looking for at least a scalp up, a couple legs up, maybe a test to the top of the sell climax. Yesterday ended with a sell to close sell climax, about 8 or 9 consecutive bear bars, many closing on their lows. And then we had weak follow through, doji, doji, bull bar, doji, doji. The market is uncertain at this point. You can call it an II pattern, a triangle, small triangle. You can simply call it a tight trading range. Bears will look to sell the bear breakout, betting that we'll get trend resumption down. Bear trend, trading range, at least a little bit more down. It's a low 2 bear flag because we have a small double top. We went down, we went up, we went down, we went up. Some bears prefer higher probability, and they wait for a bear breakout and follow through and then sell closes, or they'll sell above the high of the prior bar, betting that the bull reversal will fail. All of these bears have the same stop up here at the top of this most recent bear leg. Now we have a pullback, a reversal attempt, and we have a bear bar closing on its low. Bears will sell on a stop just below its low, betting on at least minimum trend resumption. Stop for the bears selling down here, probably at the top of this sell-off, just above, which is right here. The bears had a very strong bear trend here, but now we're getting a bunch of dojis and a lot of little reversals. This is disappointing for these bears, and it increases the chances that we're going to go sideways. A tight bear spike and channel. This is the spike down. These 4 bars, maybe these 8 bars spike down, and then a pullback. It's a channel, not all that strong. A lot of times when you get a spike and channel pattern, the market will rally and to test the top of the channel. This is in such a tight channel that the first reversal up is minor, and we're probably still going lower. We're getting a bull breakout above a bear channel. The odds are we're going to go sideways. Can you buy above the high of this inside bar? I think it's not a very high probability buy because the channel down is so tight. It's okay to take profits on shorts. For the bears, we have a very tight bear channel after a strong bear breakout, and now we have a double top at the moving average. We tried to reverse down. We're at the same price. We're trying to reverse down a second time. A small double top like this is always a low 2 short. We're at the moving average, and we have a bear signal bar. It's a reasonable short. We might still go sideways. Here we went sideways for over 2 hours, yet we ultimately went down. So the bears taking that short stop above the high of the entry bar or signal bar. Pretty good buying pressure. We have 7 bars and a bull micro channel with 5 bull bodies, but the bodies are not all that big. Plus, it's a 20 gap bar sell. We've been entirely below the moving average for more than 20 bars, and therefore, traders who are selling below the average price will be very happy to sell at the average price, which they got to do here. Other bears prefer higher probability and wait for breakouts and follow through. Every reversal attempt up is probably going to be a bear flag. It'll probably fail, so bears will look to sell on a reversal down, especially below a bear bar. We have a tight trading range, and in that tight trading range, we have a double bottom. Whenever you have a tight trading range in a bear trend and a small double bottom like this, there's maybe a 50% chance that we're going to attempt to get a swing up. And therefore, the bears will exit, especially above a bull bar, like maybe above this bar. We have the double bottom and then a bull bar. and a lot of bulls will take profits above the high of that bull bar. Some bears will sell, looking for a reversal back down. We have a breakout above a neckline of a double bottom, bad follow through, and now we have a second reversal attempt from the breakout above this double bottom neckline. First reversal down failed, second reversal down, higher probability, either selling below the bull bar or below one of these two bear bars. Again, stop above the most recent major lower high. The bulls rallied strongly here and got a second leg up here, and today's high is slightly above that high, and therefore we have three reversals down, 1, 2, 3. Even though it does not look like a wedge, it's a wedge top after a bull breakout. Because yesterday ended with a bull breakout, a buy climax, there was a 75% chance of sideways to down trading for 2 hours starting by the end of the second hour. We got sideways to down trading right on the open. We have two consecutive big bear bars on the failed breakout above yesterday's high. Also a third push up, 1, 2, 3. So it's a wedge high as well. It's a possible spike and channel bear trend. We got a spike, pullback, and channel, and we have a second leg down later. But in any case, two consecutive bear bars like that, it's reasonable to sell the close of the second bear bar, taking a chance that it will lead to a bear trend day. Some bears will sell below the low of this bar, arguing wedge, 1, 2, 3, failed breakout yesterday's high. Others will start to sell closes after the second or third consecutive bear bar. They have a higher probability short, but their stop is further away. You always pay for higher probability with worse risk reward, which means the stop is usually further away. Can you buy this reversal up after these three bear bars? I would do the opposite. After three decent bear bars, probably the first reversal up will fail. So I'd rather sell at the high of the prior bar. So rather than buying this as a double bottom here or double bottom here, I'm going to look to sell at the high of that bar. Four consecutive sell climaxes. Every trend bar, every series of trend bars is a breakout and a climax. This is a sell climax, a sell climax, sell climax, sell climax. Very tight bear channel, and therefore each reversal up probably will be minor. The gaps are closing. We have a breakout point, we went above the high. Breakout point, we went above the high. Here we have an open gap, so possible measured move down. For the bears, we're trying to reverse up. Low 1, low 2, reasonable to short. It's also a double top. And here, you can call it a double top with these two highs or a triangle. In any case, it's a reasonable short, betting on at least a little trend resumption down. So you sell here below that bear bar. The bulls see this as a trading range as well, and therefore they're looking to buy a reversal up. And we have a reversal up here. You can call this a triangle, reversal down, reversal down, reversal down. I don't have the trend line, but this is a bear break below a channel late in a bear trend. Therefore, most bears will exit on a reversal up. We're rallying here, and traders will look for reasons to sell, betting that a trading range is more likely than a bear trend. Different ways to count this. You can count it as a low 1, low 2, low 3, a failed breakout above the top of this tight trading range. The math is reasonable for at least a scalp down. We got a bear breakout, and then we're testing back above these sell entry price, the signal bar low. A lot of bears will sell below that test bar, below this bear bar, betting that the bears failed and that we're going lower. Here's a low 2, low 1, low 2, okay to sell that. If you take a sell either below this bar or that bar, stop is probably up here because we could get a slightly higher high, fairly common. It's okay to short instead below this bar. I gave some day trading examples for swing trades today, and I talked a little bit more about management. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the 4th of 5 videos on swing trading. This is Al Brooks. This is the 5th of 5 videos on swing trading examples. Thank you for watching the Brooks Trading Course. I'm going to be talking about some day trading examples of swing trades. I always pay attention to the open and how the market behaves. And if you get consecutive strong trend bars in the same direction, there's a higher probability that you'll get some continuation in that direction. Here on the open, we have a pair of big bear bars reversing down from a gap up open. And the bear bars close on their low or near their low. The market, therefore, is always in short. It's more likely to go lower before it gets above the top of the consecutive bear bars. The bulls are trying to get an opening reversal up, a pullback to the moving average, and they're hoping that this will be the low of the day and that we trend up. However, after consecutive big bear bars, it's more likely that there'll be sellers above and we'll get at least a small second leg down. Two other problems with this reversal. First, it did not quite reach the moving average, and usually if you get a sell-off that becomes an opening reversal and it's near the moving average, it has to touch the moving average or go a little bit below it. And then also, there is a fairly conspicuous tail on top of the bull bar. And the bull bar, the body is smaller than the body of the two bear bars. Bears will therefore sell at the high of the bull bar, expecting the market to go down at least a little bit. Other bears will sell this as a double top bear flag or a double top reversal, a gap up and a double top, and basically a small low 2 rally. 2 legs up, a bull bar, a bear bar, and then another bull bar. Not a great short below a bull bar, but we're probably already always in short from the consecutive bear bars, and therefore it's a reasonable short. We have a big bear bar closing on its low, closing below all the bars of the day, and there is a follow-through bar that has a bear body. That increases the chances that will go at least a little lower. The market tried to reverse up once, twice, 3 times, therefore a triangle. Anytime you have a trading range that tries to go one direction 3 times, it's a triangle. And traders will sell either the low 2 short below this bar or the triangle short below that bar, looking for at least a little bit more down. Remember, the market's always in short, and this rally is probably more of a 50% pullback of this sell-off and a breakout test of the breakout below this low, even though it went a little bit above. We have a bear breakout with 3 consecutive bear bars. The breakout probably will lead to a measured move down. The strongest part of the breakout is the open of this bar to the close of that bar. It might lead to a measured move down from the close of this bar, which takes us down here. And that is a reasonable location for the bears to take at least partial profits. I also look for a leg 1, leg 2 measured move. So leg 1, and then we pull back to a double top, and leg 2 started with this bear bar, and therefore the leg 2 projection is down here. This is a very tight bear channel. We have a 6-bar bear microchannel at this point, and now we're getting a bear breakout below a bear channel. 75% chance it's going to fail and reverse up to get to at least the top of the channel. The channel is very tight. That's not saying much, but anytime you get a bear breakout below a bear channel, it's more likely to reverse than continue down. That's another reason why bears will be taking profits down in this general area. The biggest bear bar late in a bear trend, certainly since this bar, probably is going to be an exhaustion bar, an exhaustion gap, rather than a measuring gap. The bulls hope to get above the bottom of the gap, The bulls want to close the gap. We have a bear breakout, a 2-bar bear breakout, and the gap is between the close of this bar and the low of any of these bars. And the bulls want to get above all of these bars, and especially above this bar. This is the follow-through bar after the big breakout bar by the bears. Terrible follow-through. Probably will reverse at least a little bit up, at least to the top of the sell climax bar, maybe to the top of the 2-bar sell climax. We have a 2-bar breakout, 2 consecutive bear bars, bigger bodies closing near their lows. Maybe the breakout point is this low, and therefore the top of the gap is this low. The top of the sell climax is this high, and that is always a target whenever you have a sell climax late in a bear trend. It's a bear spike and channel. We have a bear spike, a bear breakout, a pullback, and then a channel down to around a measured move down from the height of the spike, and a leg 1, leg 2 measured move. Bulls will buy a reversal up above this bull bar, betting that we'll get at least to this high, possibly to the top of the channel up here. This is also a good location for the swing bears to get out. They know that, yes, it's still always in short, but they don't want to see a bull bar after 2 bear bars breaking out below a bear channel. And they don't want to see a reversal up at a measured move target and a leg 1, leg 2 measured move. They don't want to see consecutive bull bars. They don't want to see 3 consecutive bull bars. And therefore, the always-in bears will get out. Probably by the 3rd or 4th bar, most traders look at this as always-in long and expect at least 2 legs sideways to up. Leg 1, pullback, leg 2. Is it a minor reversal or a major reversal? It's a 10-bar tight bear channel, and it's inside maybe a 30-bar very tight bear channel. Not a clear big wedge, not a clear lower low major trend reversal. Therefore, this is probably a minor reversal that will lead to a rally up to test resistance, either at the top of this bear bar, the top of these 5 bear bars, or the top of the channel. Remember, this is a spike pullback channel. The market usually tries to get to the top of the channel and then enters a trading range. Is there enough room for the bulls to buy for a scalp? Well, there probably is. Is this going to lead to a bull trend? Probably not. If the bears want, they could stay short and keep their stop above the top of the bull trend, or maybe at the top of the spike, possibly the top of the bear channel. But that is an obvious magnet, and the market's going to try to get there. Most bears, given this set of circumstances, the measured move, the bear breakout below the bear channel, a good-looking bull bar after the bear breakout not being particularly good, most bears would exit above this bull bar, or certainly by the 3rd bull close right here. Aggressive bulls would buy here, or they'd buy the 3rd or 4th bull close, looking for at least a couple legs sideways to up. The bulls, they'll buy where the bears are getting out. The bears get out either above the reversal bar after the sell climax, or on the 3rd bull close. We sold off and then entered a tight trading range, a triangle. It's a limit order market. Bears will sell above bars, above this bear bar, above this bear bar. And the bulls will buy below bars. The bulls will buy either at this low or lower. They might buy the size of a scalp below, maybe the size of 2 scalps below. The bulls will use a wide stop, betting that this is not a very strong bear trend. Bad follow through after this breakout, bad follow through after this breakout. It's probably a bear leg in what will become a trading range. And therefore, bulls are willing to buy at prior lows and scale in lower. Bears are looking to sell above bars, expecting the swing down to continue. They'll sell above this bear bar. We have an attempt at a double bottom, but not a good buy signal bar. The bears will sell here as well. Stop maybe above the top of the most recent strong bear leg. Bulls place limit orders to buy at the prior low, low of this bar, the low of that bar, betting that the bear breakout will fail. At a minimum, the bulls who are buying below the bottom of this small trading range need to stop at least more than a measured move down. The top of the bear sell-off, the bottom of the bear sell-off, measured move down, stop a little bit below. A lot of these bulls will buy the size of a scalp below the first entry, maybe twice the size of a scalp below the first entry. More will look to buy above a bull bar reversing up if the stop does not get hit. This is a logical location for a stop. The bulls who bought here will hold short, hold short, hold short, and when they get a decent looking bull bar, they'll buy on a stop above its high, expecting the market to come at least back to their original entry where they can get out break even on their first entry, and then with the scalp on the second. They'll only take this second buy if it's at least the size of a scalp below the first entry. They prefer it to be 2 to 3 times the size of a scalp so that they can make 2 to 3 times the size of a minimum scalp on the reversal up. Is it a swing up? Very tight bear channel. Probably the first reversal up is minor, and it'll lead either to a trading range or to a resumption of the bear trend, a bear flag. Once it gets back to their original entry at the bottom of this trading range, a lot of bulls will take partial profits or full profits. They get out break even on their first entry and with a profit on their second entry, or they get out break even on their first entry and then hold and wait until there's a credible reversal down. This is about a 10-bar bull microchannel with a lot of bull bars. A lot of the bulls will not exit below that bull bar, but they might exit below this bear bar, the second reversal down, second or third reversal down, after a minor reversal that's probably going to lead to a trading range. You do not want to be holding long near the top of what you believe will become a trading range. We have consecutive strong bear bars, but we have a tight bull channel, an 11-bar bull microchannel. No pullbacks for 11 bars, only one small bear bar. Probably a minor reversal down and a trading range. However, the reversal up is probably minor as well because the channel down is so tight and there's no clear bottom yet. This is not a good lower low major trend reversal or a good wedge bottom. And therefore the rally is probably a bull leg in a trading range or simply a bear flag. When there are consecutive bear bars like this, and we have a potential double top bear flag, break below the neckline, measured move down, the bulls will get out either below this bear bar or on the close of the second consecutive bear bar, because at least 2 small legs down are likely, 1 pullback 2 or 1 pullback 2. The swing bears who exited above this bull bar are looking to sell again, and it's reasonable to short here. However, after 11 bars up, they'll probably get a second entry short with a decent sell signal bar, which they have here or here or here. Therefore, the swing bears, the bears who are looking for a swing short, will sell either here or below this bar here or below this bar here or below this bar here, looking for a swing down. We have 3 reversals up, 1, pullback 2, pullback 3. It's a triangle, probably leg 1, pullback, and then leg 2 or leg 2. It's reasonable for the swing bears to take this short, put a stop above the high of this bar, and hold on to see if they get a swing down. We now have a pair of consecutive bear bars, both closing below this higher low. Probably we're going to get more down. Not good follow through here or here, but bears can sell that close, stop above the top of the most recent bear leg. We have a bear channel yesterday, and now we have a big gap up. We have a 2-bar reversal. The market tried to sell off. It's trying to resume up again, but forming a double top. We have another bear bar closing near its low. Some bears will sell this as a double top with yesterday's high. They'll sell below the bear bar and put a stop just above its high. We have a bear bar and a follow-through bar. Okay to sell the close of this bear bar or sell below the low of this bear bar, taking a chance that this is the high of the day. We have consecutive bear bars, and one of the bars is very strong. At this point, we're always in short, probably at least a small second leg down before we get above the top of the original sell-off. Because we're always in short, and this is not a good buy signal bar, some bears will sell at the high of this bar, get filled here, or they'll sell the size of a scalp above the high of that bear bar and get filled there. They'll bet on a lower high and at least a small second leg down. At this point, we have a wedge higher low. we have a low here, and then we have a reversal up here, second reversal up, 1, 2, and this is possibly the start of a third reversal up. It's reasonable for the swing bears to get out above this bar because of the possibility of a gap up and a wedge higher low of the day, opening reversal up from the moving average. Technically, at this point, we're still always in short, and it's reasonable for the bears to stay short, stop above the top of the sell-off. Even though this bar has a bear body, it's still either a high 2 or a wedge bull flag near the moving average. It's reasonable for the bears to exit short. It's also reasonable for the bears to hold short with a stop above here. Now we have a pair of consecutive bull bars, and the bulls could buy this close, betting that we've become always in long. We have an opening reversal up from the moving average. We have a big breakout above a bear channel, a bull flag, and a two-legged pullback to the moving average, or near the moving average. Now we're reversing up, and now we have consecutive bull bars. The bears want a double top with this high. The bulls want this to be an opening reversal and the start of a big bull trend day. Both have reasonable arguments. When that happens, usually the market ends up going sideways. For the bulls, if they took this buy, their stop is below the bottom of the wedge. Since we may get one more push down, 1 pullback 2, pullback 3, some bulls will use a wider stop and in fact buy more at this low, betting that just like we fell below this low and reversed up, if we fall below this low, we'll probably reverse up as well. The bars are not big. We're still below this high and still below the top of the initial sell-off. Maybe we're a little bit above this high, but we have not broken strongly above it. And again, the bull bodies are not particularly big, and the second bull body is smaller than the first. And therefore, instead of the momentum picking up as we reverse out of this bull flag, we're losing momentum. At this point, 4 of the past 5 bars were bear bars. That also weakens the bull case. Bulls need more than simply a break a little bit above this lower high. They need a breakout above the high of the day, especially a strong breakout above the high of the day. Otherwise, this is not likely to lead to a bull trend, and it will probably lead to a trading range or even a bear trend. The bulls are continuing to push up, but where are the consecutive big bull trend bars? We're probably always in long at this point. A lot of the bulls would get out below this low. A wedge, 3 pushes up, 1, 2, and then 3. It's reasonable to get out of longs there. Some bears would sell here. Other bears would be concerned that we have 9 bars up without much of a pullback, possibly an early small pullback bull trend. The picture is confusing. Whenever the picture is confusing, the market usually goes sideways. For the bears, reasonable to sell here, a wedge lower high. 1, second push up, third push up, lower high, testing the high of the double top. Decent bear bar closing near its low, reasonable to sell on a stop just below its low and put a stop above the high of the day, taking the chance that this is going to be a bear trend, with the first bar of the day being the high of the day. For the bulls, we're probably always in long. It's okay for them to hold long, betting on a double bottom bull flag and a break above the high of the day and the start of a swing up. Which side has higher probability? Well, both have reasonable arguments, and I think it's pretty much 50-50. 50% chance we'll get a bull breakout and a swing up, 50% chance we'll get a bear breakout and a swing down. It's reasonable to be holding long with a stop below here. It's reasonable to be holding short with a stop above here. We have a bear break below the wedge lower high and a follow-through bar, so we're back to always in short for a swing down. The bulls who bought or were holding long would either get out below the low of that bear bar or on the close of either of these bear bars. The bears who get out above this bear bar would have to go short again below this low 2 short, low 1, low 2, and a lower high. Or they would wait for consecutive bear bars and then sell the close of this bar. This big bear bar is a sign that the bulls are finally giving up. The bulls who bought here or above here, hoping for a break to a new high, this bar is telling us that they're getting out, they're desperate to get out, they're eager to get out, and they all sold, and it created a big bear bar. And the bears saw that as well, and they sold in addition to the bulls. Some traders will sell the close of the bear breakout below the wedge lower high. Others will wait for the close of the second bar and sell there. Others will sell a low one short. When we try to reverse up, it's a low one short below that bar, and they'd get filled over here. Reasonable setup for at least a second leg down and probably a measured move down. We're sideways for the first hour. Probably when we break out, we'll get a measured move up or down. And it looks like at this point, we're going to get the break below the low of the day and then a measured move down. We have a bear breakout and a follow-through bar. That could lead to a measured move down as well. Open of the first bar, close of the second bar, measured move target here. You can argue the entire 15 bars, 20 bars is a breakout mode setup, and therefore a breakout will lead to a measured move down. This high, that low, measured move down. A double top reversal, double top, neckline, measured move down. Consecutive bear bars here and here, consecutive sell climaxes. These two bars, that bar. Whenever you get a series of sell climaxes with bad follow through after every sell climax, here, and then a doji, 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 here, bull bar, doji bar, you're probably going to get a reversal up to at least a trading range. Now we have the biggest bear bar of the day, 20 or more bars into a trend. Whenever you have the biggest bear bar occurring 20 or more bars into a trend, it's more likely to be an exhaustive end of the trend than it is a measuring gap and the start of a new leg down. Bulls, therefore, will look to buy a reversal up, like above the high of this bull bar, or here we have a micro double bottom, up, down, trying to go up. If you're a sell the close bear who sold this close or that close, and then you see this, what are you thinking? You're thinking, gosh, I don't like that. That's bad follow through, and this could be a higher low. So this could be a bull breakout and then a bull flag leading to resumption of the trend up, leg one, pull back, leg two. The bears who sold that close or the follow through bar close are disappointed, and a lot of them, as soon as they see the close of this bull bar, will try to get out break even. They'll place a buy limit order to exit their shorts around their original entry at this close or that close, and that caused this, and here the final bears are buying back their shorts. The bears were hoping this big bear bar would lead to a second leg down, and it did. This pause bar, followed by this bull bar, might be the second leg down. This little bear bar will be the second leg down for other bears. And that might be all that the bears get. They kept trying to get a bear breakout, and so far all they're getting is a tail on the bottom of a bull bar, and then a bear bar followed by two bull bars. The bears are failing, and they're probably going to give up soon. The bears who sold this close are disappointed by this, and again by another bull bar here, and they're trying to get out break even, and the final bears gave up here or here. Bulls know what's going on. They see the biggest bear bar, 20 or more bars into a bear trend, and they see the higher low, and they see the follow-through bar. They know it's a sell signal. However, they also see consecutive sell climaxes. Here, bad follow-through. Here, bad follow-through. Here, bad follow-through. Here, not all that big a breakout, bad follow-through. Here, maybe we'll get bad follow-through, and maybe this will form a higher low. Therefore, in this kind of a circumstance, aggressive bulls will start buying where the bears are selling. They'll buy the bear close of a big bear breakout and the follow-through bar, and they'll start buying below bars at the low of this bar, at the low of this bar, and get filled here. The bulls who take those buys need a stop at least below a measured move down. Maybe from the open of this sell climax bar to the close of this bar or the close of the follow-through bar, they need to stop a little bit below its low, maybe a stop a little bit below this low. They're buying, betting that it'll get to the top of the final sell climax before it falls for a measured move down, and that is reasonable. Many bulls will not take those aggressive buys, buying the bear closes. They want higher probability. They need a reversal up before they start to buy. We have a bull bar here. Maybe they buy above this as a micro double bottom, knowing that the sell the close bears here and here will buy back the shorts. Others will buy the close of this bull bar, consecutive bull bars, looking at a minimum for a test of the high of the final sell climax, and possibly the test of this spike pullback channel. Other bulls will buy with limit orders. At this point, we've had 4 consecutive bull bars. The bears can argue wedge bear flag, a pullback low 1, pullback low 2, pullback low 3, but a terrible sell signal bar. It's a bull body, and we've had 4 bars out of the past 5 having bull bars, bull bodies. Probably more buyers than sellers below the low of that bar. And the bear bar, especially with that tail below, probably more traders buying that close than selling that close. And the same here. A lot of bulls will buy it, betting on a small double bottom, high or low, and swing up. Other bulls will buy with stops. We have a small bull flag after reversal. They'll buy above the high of that bar, stop below here. And now we have either a double bottom bull flag or a small triangle, 3 pushes down, 1, 2, 3, and we have a bull bar closing on its high. They'll buy above that bull bar or above this bull bar, hoping for a trade up. We have a breakout, 3 consecutive bull bars, closing above the top of this trading range, this triangle. Some bulls will buy above the high of a bull bar here, looking for at least a scalp up. Remember, this sell-off is in a tight bear channel. The first reversal up, no matter how strong, probably will be minor, which means it will either become a bear flag or a trading range. And in either case, it probably will sell off soon. So it's getting risky to buy too high near potential resistance, the top of the spike pullback channel. Buy the closed bulls, they'll buy closes all the way up. One bull is not going to buy all closes. Some traders do, but much more common, they buy 1 close or 2 closes and then look to scalp out part or swing part. When the market tries repeatedly to do something and fails, it usually then tries to do the opposite. It usually reverses. Just like the bears had bad follow-through all the way down, and it led to a reversal, this sell-off became a bear leg in a trading range. The rally has problems as well. Bull bar, bad follow-through. Bull bar, bad follow-through. Bull bar, bad follow-through. Bull breakout, not very big, bad follow-through. And therefore, this rally probably is a bull leg and will become a trading range. Also, because it's such a tight bear channel here, this is probably a minor reversal, which means instead of a bull trend, it probably will go sideways and form a trading range. Context, good for a trading range. We reversed down from yesterday's high, and we're reversing up from near yesterday's low. We have a bear leg in a trading range, expect a bull leg in a trading range. We have a bull leg in a trading range, expect a bear leg in a trading range. In a trading range, traders look to buy low and buy more lower. They look to sell high and sell more higher, and they look to take quick profits. They're not looking for a swing trade. The rally here might simply be a breakout test below this breakout point. Even though it went a little bit above, it's also a wedge rally. 1 pullback, 2 pullback, 3. And it's about a 50% pullback, a little bit more. All are reasons for traders to begin to take profits. Also, the bulls see it's 3 pushes up, so it's a wedge rally, and the follow-through after each leg up has been bad. So the follow-through after this bull bar will probably be bad as well, and the bears might get a couple legs down toward the bottom of the trading range. For the bulls, they have a bear flag here, but instead of a bear breakout, we have a bull breakout, and the pullback twice held above the top of the breakout point. and therefore this might be a measuring gap. Here's the start of the reversal. Here's the potential gap, and traders will expect profit-taking bulls and aggressive bears to sell around a measured move up. It's also the top of this channel, spike pullback channel. A logical place for bulls to take profits and for aggressive bears to begin selling. I talked about the wedge channel, 3 pushes up, 1 pullback, 2 pullback, 3, and we're trying to get a bull breakout above a bull channel. Usually it fails and you get at least a minor reversal down to the bottom of the channel. The channel is very tight, so it does not take much of a move down to hit the bottom of the channel. I do not have the trend line drawn in. For the bears, they have a decent sell signal bar. Now they have a wedge rally. It's a reasonable short. Aggressive bears will sell the close of this breakout bar. Even though it's not particularly big, it's the biggest bull bar in about 20 bars, and therefore likely to be a climactic end of the rally. It's also around a measured move up from this gap, this high and these lows, and is near the top of the first pullback after the reversal down. All of those reasons are good enough for traders to start to take profits, for the bulls to take profits, and therefore the bears will sell. Aggressive bears will sell a strong bull close, betting against the breakout, betting instead on a climactic exhaustion gap. Other bears will sell below bear bars, like right here, getting filled below the low of that bar, getting filled right here. If you take that short, where do you put your stop? At a minimum, probably a measured move up. We have a gap this high, that low, and we're already at that measuring gap. Maybe we'll get a measured move up based upon spike pullback channel, which is up here. And therefore, the bears selling here, they can either get out above the top of the wedge, or they can use a wider stop and scale in higher above this bar, but below their stop. The rally is a fairly tight bull channel, and a lot of bears want a higher probability short. They have 3 consecutive bull bars here, and then 3 here. Therefore, a lot of bears will not take the first reversal down. They'll wait until we get 3 or 4 bear bars, and then they'll sell closes, or they'll sell at the high of the prior bar, looking for at least a small second leg down. Here's 3 consecutive bear bars, 2 closing near their lows. After a wedge top and a double top and a lower high, it's reasonable to take the short, looking for a test of the bottom of the bear trend. Traders who take the short, selling that third close, most of them will put a stop above the top of the reversal. After 3 bear bars, a wedge top, and a lower high, and a double top, a lot of bears will sell with a limit order at the high of the prior bar and get filled here, or above the high of this bar and get filled here. Others prefer to sell with stops. They'll either sell below the wedge bar here, or they'll wait for some kind of a double top, this high, that low. Therefore, a double top bear flag or a double top lower high. Traders will sell below a bear bar, like below this bar and get filled here, or simply below the low of the prior bar. In this case, a bull bar, but some bears will take that short because it's a low too short after a reversal from a lower high. Now we're getting 3 bear bars, 4, 5, 6, 7 consecutive bear bars. Traders will start selling closes, especially when we start to get closes near the lows of the bar, here or here. Stop above the top of the bear leg. And a lot of these bears will be willing to sell more higher if the market immediately reverses up after they enter. They'd keep their stop up here. At this point, we've had 6 consecutive bear bars, a very tight bear channel. 6 consecutive bear bars is a breakout on a higher time frame chart. If this is a 5-minute chart, these 6 bear bars probably will be a strong bear bar on the 60-minute chart and 2 strong bear bars on the 15-minute chart. The odds are we'll go at least a little lower. A wedge rally, probably at least 2 legs down, maybe 1 pullback 2, but when those 2 legs are in a very tight channel like that, it's usually a more complex reversal, and the entire bear channel becomes the first leg, pullback, and then a second leg. A big bear bar, 20 bars into the bear trend, is it more likely a measuring gap or an exhaustion gap? We're near the bottom of a trading range, probably an exhaustion gap. Therefore, traders will look for a reversal up, especially a second entry buy. This bar went above the high of that bar, but not a very good buy. And then this bar was a decent looking buy signal bar, and the next bar went above it. Stopped below here for the bulls who took that buy. We reversed down here, here, here. We reversed up here, here, here. If you want, you can call it a triangle. You can call it a tight trading range. In any case, it's breakout mode. When you have a breakout mode set up, here a triangle, 50% chance the first breakout will fail and reverse. When you ultimately get a successful reversal, there's a 50% chance it'll be up, 50% chance it'll be down. Can you redraw the triangle and call it a double bottom, higher low, major trend reversal, bear trend, bull breakout, and then a double bottom, higher low? A lot of computers will do that, and they'll look to buy above the high of a bull bar, like right here, especially since it's a second entry buy. Here's the first, and then here's the second. Triangle, breakout mode, and a limit order market. Bulls will buy at the prior low and buy more lower as long as the second entry is at least as big as a scalp, and bears will sell above, betting that the reversal up will fail as well. Here's a second reversal up. This bar traded above the high of this bar, so that's the first reversal up, not a good buy signal bar, and this is the second reversal up. It's a high 2. Traders can either buy above the high of this bear bar, or, if they prefer, buy above the bull bar. It's slightly higher probability that it's the start of a swing. At the end of the day, the bodies are getting bigger, and we're starting to get bars closing on their highs. And we have a trading range day that is finishing up as a buy the close bull trend. Maybe after the third or fourth bar, traders will start buying closes, and they'll get out below a bear bar, and they'll even get out below a bull bar if the bull bar pulls back 4 or more ticks below the low of the prior bar. When that happens, there's a higher probability that the breakout is going to reverse into the close. End of the day, buy the close bull trend. Some bulls will take 2 or 3 of these buys and just keep adding on to their original position. Most traders who are looking for multiple buys are traders who took partial or full profits after the first buy. In other words, they scalp out and then they look to buy again if the market remains strong. The first bear close and a buy the close bull trend, the bulls will buy it, betting that the first reversal down will fail and it will go at least a little bit higher. In general, when you have a reasonably strong buy the close bull trend, the bulls will exit a little bit below the low of the prior bar, usually 1 tick or 1 pip, and they'll also exit 4 or 5 pips or ticks below the low of the prior bar. This bar did not trade below that bar, but a lot of the bears would have sold below the low of this bear bar. At the end of the session, near the top of the range, it's reasonable to take profits and then start to trade again tomorrow. This was a video talking about additional swing trading examples for day traders. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the 5th of 5 videos on swing trading.